We go. Yo, what is up for everyone watching this on the YouTube replay? I hope you're having a great day. In this video, I want to go over a couple stocks that I just bought for the first time ever. As we know, the market has been doing pretty rough recently, so I decided to take advantage of this and I sold one company. First off, I'll go over the company I just sold and then I'll show you the new stocks I just bought for the first time ever. So the company I did sell all my shares of is Disney. Now, this one isn't the most quality stock. I really felt like it shouldn't be in my long-term portfolio. Disney technically is the same price that it was in 2015. So I decided to sell all my Disney, and with all the funds of that, and I deposited a little bit of money, but let me show you what I bought with that. I decided for the first time ever to buy two new companies. I bought Uber first off. This company, I think, is a steal of a deal. Let me give you a deep dive into Uber's fundamentals, because I'm not just buying them because they're on a dip right now. I'm buying them because they're a high quality company that I want to own that's getting into robo-taxis. They also just acquired Spot Hero, which is this parking app. I love everything they're doing. Yeah, Uber partners with Pony AI to launch commercial robo-taxi service in Europe. Uber in talks to acquire German premium chauffeur service Backlane for a high three-digit million euros. So for a couple $100 million, they might buy Backlane. Uber and Rivian finalized deal for 50,000 robotaxis in 2028 deployment. Pretty cool. And this company also is cheaply valued, in my opinion. On the right, they only traded a 20 forward PE. If we look at their, excuse me. We look at their current PE, they only traded a 14 PE, but the forward PE is a 20. And we're looking at the forward PE because they had a slight one-time adjustment to their net income, making it look higher than it actually was. Like last quarter, whereas it says they made $6.65 billion in net income. They actually made $1.1 billion, which was still a record quarter. If we zoom out, this is the number we want to look at. This is their profits they make without those little gap one-time adjustments that are just completely one-off. This is their real money they're making, and it's at a record this quarter. So record profitability, not just on the net income, but also the free cash flow. They literally make over $2 to $3 billion of free cash flow a quarter. So no wonder they're doing all these acquisitions and getting exposure to robo-taxis. But let me show you how they're still growing. Like, the growth is not gone for them. Here's a really important metric. This is their monthly active consumers. So not just monthly active users, but monthly active consumers, people consuming the product, are at 202 million, when the same time last year it was 171 million. So that's a great improvement. If you go to their main business, mobility, ride sharing, it continues to grow nice double digits. It's up 18%, after grew 25, after grew 33, after grew 74. So the post-pandemic boom of Uber is still happening. Like, they're still growing insanely, and not just on the mobility side, but also the delivery side. And this isn't just Uber Eats, which is most of this, but they're also doing B2B business delivery. So check this out. This is the highest growth rate on the screen at the top. It's nearly 30%. If you look at all the other growth rates on the screen, it used to grow kind of low single digits, mid single digits, but now 30% year over year. Insane growth. They're also in freight. But yeah, also they have a lot of international exposure. They also are acquiring a bunch of companies. As we know, they're the largest shareholder of Grab. So I'm a big fan of them. They have basically no net debt at all. So that's why I just bought Uber. Cheap valuation. Again, they only trade at 20 times next year's net income. I feel like Uber, with the growth they have, should be trading at a much higher multiple. Something to like a 25 to 30 would make sense to me. So anyway, that's why I bought Uber for the first time ever. There's my 12 shares. As you can see right there, I bought it at 68.87 all on Friday there. So yeah, that's the first stock I just bought. And the second stock I bought was Microsoft. And yo, what is good? Looney, Vulcan, Gent, MC, good to see everyone. I want to go over this last stock here, and then we'll look at some of y'all stocks. Absolutely. So next up, we have Microsoft. This is my newest position. I just bought on Friday for the first time ever. It's too cheap to go wrong. I really feel like, not financial advice, Microsoft is one of the best buys in the entire market, and it's just super like fair. They're a very quality company. They're a Mag 7 name, software, cloud, AI giant. I mean, the biggest in the world. I mean, they own 27% of OpenAI. So pretty cool right here. I know there's some bad news right now. Like, OpenAI discloses Microsoft dependency as a business risk. So they literally own 27% of all of OpenAI, and they have like exclusivity cloud rights and stuff like that. But anyway, check this out. If we go on the right here, Microsoft, this behemoth only trades at 20 times next year's net income. I think that's so cheap. That's super cheap. And another reason why they're falling is because they are a software name. If you look at a lot of software stocks, Salesforce, Adobe, they have all been struggling. That's because Microsoft is also a big software name. Potentially, they're saying like Claude or whatever could replace Excel and spreadsheet. And I don't really think that's going to happen. But yeah, their main business right here, 42% of all the revenue is their software business. And this does over 120 billion of annual revenue for Microsoft. And not just that, they're also a huge cloud play. Their Azure cloud, it's the second largest cloud market share. This also does over 110 billion of annual revenue for Microsoft. So it's just insane. And if we go to their net income, they now make over 30 billion in net income a quarter. And that's what analysts are projecting. This is real after-tax net income. They had a slight adjustment this quarter as they took a gain on some OpenAI stock. But look, net income next quarter is supposed to be 30.5 billion and then 31.6 billion. So net income's just up and to the right. They have a better credit rating than the US government. So the US government's more likely to go bankrupt than Microsoft. So anyway, I love this stock, and you can't go wrong. You get over 1% dividend too. It's a dividend growth stock. It says it's a 0.95. It's actually higher. So you buy the stock now, you're getting over 1% of your money back just in a qualified dividend every year. A 20 forward PE, exposure to AI, cloud, software. It's an ETF in one. So yeah, and they're doing a bunch of like deals for nuclear supply, and it's just pretty cool. So that's why I bought Microsoft stock also for the first time ever. I mean, it's the like third, fourth largest holding in the S&P 500. So yeah, I just bought Uber, Microsoft, and the last stock I just bought was Reddit. I bought another share of Reddit. A lot of people might not roll their eyes or something, but Reddit is for real a growth name that I think you should pay attention to, and it's finally really cheap. Like they only trade at like 23 times net income or forward net income on my math. So check this out, or I'll kind of start the context off here. Reddit's worth $23 billion. And I project they're going to make $1 billion in net income a year. And check this out. Here's what the analysts project. They're supposed to make like next quarter, 119 million, 173. But notice every quarter they beat on net income. They made 250 million of after-tax net income this quarter. And if you annualize 250 million, that's $1 billion in net income a year. And the whole company's worth 23 billion. So that's a 23 forward PE. But it gets even better because this company has no debt, and over 10% of their market cap is actually, it's now like 12%. 12% of what you're paying, just their 12% of their market cap, just their cash. If you look at the very top right, they have 2.48 billion of cash, call it 2.5 bill of cash, zero debt. $2.5 billion of cash is over 10% of their whole entire market cap. So you can take 10% off that PE ratio. So anyway, that's why I think Reddit's a pretty fair company, and they're growing like a beast. Look at these year-over-year growth rates at the bottom. It's like the green line. Revenue's up 69, last quarter is up 67, 77, 61. So they're growing like a behemoth. If we zoom out, they're also getting basically royalties. They're licensing out their proprietary high-quality data to train LLMs right now. So that's another portion of business. Their ARPU, their average revenue per users going up. It's up like 30, 40% year over year. So they're making 30 to 40% more money per average user than they were a year ago. So anyway, and they're just falling because just everything is, I don't know. So anyway, I bought one more share at Reddit, and that's really all that I've been doing. So happy Sunday, everyone. Let's look at y'all stocks. How's it going? Jen said Krato. This is a very high quality stock. I saw someone say Mahi said Amazon. Yeah, that's another huge holding of mine. Yeah, I definitely want to go over Amazon. This is right where I've been buying more Amazon stock at. Yeah. I'm only up 1% on my Amazon shares, but let me go over Krato real quick. This is a copper, cable, and fiber optic company. If you like growth stocks, I think you'll love this one right here. And they're actually very cheap for the for the growth that they have. On the right, actually on the left, they look really expensive. They're at 52 PE. But on the right, they only trade at 26 times forward PE or 26 times next year's net income. That's where it starts to get actually inexpensive. And here's why I think they deserve a higher multiple than that. Check out the revenue. Revenue growth is insane. It's up 200% after it grew 154. Like it's triple digit growth for the past 6 quarters in a row. So revenue's up 200%, and it's not just the revenue, but the net income as well, the actual profits. If we zoom out, the net income this quarter literally at a record, 150 mil in net income. So that means their net margin, dang, 38% net margin. They're having margin expansion. That's insane, actually. And a huge cherry on top as well is they have no debt. This is a fortress balance sheet. They now have $1.3 billion of cash and zero debt. In this kind of environment right now, that's super good. And you know what? I bet they're earning interest on their cash. That's kind of the cool part. Let's actually see. Yeah, they made $9.5 million of just interest on their cash. Wait, did I look at the right metric there? Hold on. Oh, it's right here. Yeah, right here. They actually made 9.5 million of just interest on their cash pile because in the higher interest rate environment, they can earn interest on their cash. Anyway, I think this is a very fair company to add. I think you'll like the growth. They have no debt, 25 times next year's net income, and at this sort of growth, I think that's fair. That's Krato Technologies, a copper cable supplier, and they actually have some deals with NVIDIA. Same with the Amphenol. That's actually another one. They actually look very similar. Like they're all on like this downtrend right now. I actually like Amphenol. That one actually, full disclosure for Krato, they are headquartered in the Cayman Islands and don't pay taxes. I'll show you that right here. Look, so one thing about Krato, if you look in the middle here, they're actually headquartered in the Cayman Islands. So their net tax rate is a 0.2%. They pay no taxes. But that could be cool about them. Ooh, someone said ARM. Let's do ARM real quick. This is a royalty company and they're actually making their own chip. So right now they just make this like energy efficient component in every chip. Every Apple chip uses it, NVIDIA chip. But right now, because it's just a component in a chip, they're now actually going to start making their own chip. ARM Holdings CPU competes directly with Intel and AMD and server processing unit. Yeah, so they're literally making now the entire CPU and GPU. So that's what's pretty cool about ARM because, well, let me show you give a context about ARM. Here's what they are right now. They're a royalty and licensing company. That's why I love ARM. Literally 62% of the revenue is their royalty revenue, and licensing and revenue is also super high margin. So if we go to the gross margin right here, this is insane. I don't know any other companies that have a gross margin like this. A 98% gross margin because it's literally just royalties and licensing income. And their net margin is around a 15 to 20% net margin. But maybe they're seeing that they could make their own chip because that's high margin as well, 40, 50% net margins, or that's what NVIDIA's at. NVIDIA's at like a 60% net margin. So anyway, I really like ARM. The only trouble is, and I'd love to own them, they're extremely expensive. Like that's the unfortunate part. Like not just like a little bit expensive, they're like extremely expensive. Like 160 times next year's net income, which is like Tesla type expensive. All right. Let's see here. What did I want to look at next? Hey, what's up? MC said Lulu. Yeah, so I'm not too big of a fan of the apparel stocks because they're kind of a commodity, but dang, like look at this. And it's not just Lululemon struggling, but yeah, they're the same prices they were back in 2018. I think Nike is as well. If we go to Nike stock, Nike is, dang, they're the same prices they were back in 2015. So I know they're also having some tariff headwinds and some growth issues. Let's see if there's any news around. No, there's no real news around Lululemon. Can we get a earnings analysis? Let's see. Well, anyway, let's just go look at what they reported. So revenue grew 0.8% year over year. So that doesn't beat inflation. So the growth is kind of slowing down. Revenue is only up 0.8. And the net income fell 21%. Was that real? Ooh, so the net income really did fall 22%. That means margins are collapsing. So look at this basic metric here. Gross margin is down 9%. Net margin is down 22%. So their margins are coming down, but they still have a good margin. Like, look, 15 to 16% net margin. This still makes them 300 to 500 mil in net income a quarter. It's just that's probably why they're losing. That's probably why the multiple is coming down because they're trading it now like a multiple that like American Eagle or I don't know what I'm trying to think here. Like a Louis Vuitton, like LVMUY. Louis Vuitton is public as well. They don't know. Actually, I like this as a safer buy. If you're looking for an apparel stock to buy on a dip, I actually like Louis Vuitton as a bit of a safer buy because you get many other brands with it as well. And they're in very other higher margin industries because, obviously they sell the leather goods where they're the leather bags, but they're also in watches and jewelry. That's really high margin. Perfume and cosmetics. Spirits, they own Hennessy. So it's interesting company here. They only traded a 19 forward PE. So anyway, it's the whole industry that's struggling. But Lululemon's still not terrible. They still make a crazy amount of net income, 300 to 500 mil a quarter. Hey, what's up, Plasma? Good to see you, dude. I love Microsoft Maneuver. Same here. Same here. He said Vistra Energy. This is a nuclear play. They are like the second largest owner of nuclear reactors. I think they own like 6 nuclear reactors right now. But they mainly do natural gas, and they're an unregulated utility. So let's go look at their forward multiple because they've having some one-time adjustments. Like if we look right here to their net income, it says they lost 268 million that quarter. They didn't actually, they really made money. So anyway, you look at a forward multiple here. This is the interesting part. They only trade at 18 times forward PE. So Vistra Energy only trades at 18 times next year's net income, which is very interesting. So yeah. I know they pay a dividend too, a 0.6% dividend yield. That payout ratio is going to go way down. But yeah, they basically just sell electricity to data centers. And since they're unregulated, they've had a ton of pricing power right now. The price of electricity has been going up and up because data centers have been, taking all the electricity. They're very electricity heavy. So that's another very similar to company that performs and moves very similar to that one is Constellation Energy, and this is the one I own. That's the second nuclear company with six nuclear reactors. This is the number one nuclear company with over 33 nuclear reactors. So I like CEG a little better. They're also an unregulated utility, but I think Vistra Energy and Constellation Energy will be some of the growthiest utilities out there. I also own a regulated utility. I mean, these regulated utilities are pretty interesting because no matter what, they always return you around 7% of your money back a year because the government, like what's so cool about the regulated utilities is if they don't get a positive return on their money, the government guarantees them a positive return. Like they can't lose money. It's kind of interesting. The government guarantees them a return, but on the other hand, they can't raise prices unless the government allows them to. And right now, they're saying, hey, data centers are taking all this stuff. Can we raise prices a little bit? And they're actually saying yes. So anyway, these always do so good. You get a 3.1% dividend and only trades at 20 PE. That's one of my newest purchases. Good dividend play. All right. Let's keep going. Hey, Jackson, dude, Jackson, thanks for all those gifts. I really appreciate you, brother. He just gifted like 50 roses. I really appreciate you. Microsoft done. Yo, we just deep dive into Microsoft a minute ago. That was the first stock I actually looked at because we just bought them for the first time ever. So yeah, Microsoft is not done. I'm a buyer right here. So if you give me a minute here, a couple minutes, we'll actually swing back to Microsoft and analyze them in a minute. But we just covered them, so I don't want to like go right over them again. But if you give me a minute, we'll definitely check them out. Or if you have a different stock, Jackson, I got you. So let's see here. FICO score. Yeah. Hey, or FICO stock. Yeah. Hey, Danny, there is one headwind for FICO right now is that the government is making their own score. Actually, let me go kind of pull up the Morningstar research right here. Yeah, so look at this. Here's what the bears are saying. The FHFA decision to allow VantageScore for government-conforming mortgages will alter its pricing strategy, could result in VantageScore gaining traction in both mortgage and non-mortgage markets. So basically, they used to have like no competition. The FICO score, they've had a genius business. Excluding that little noise right there, basically whenever you're making a high-ticket purchase like a car or a house, you're paying a couple dollars, like $6 for your little FICO score in total. But they've had tremendous pricing power where it's like if you're buying a house for a couple $100,000 or a car or whatever, they can charge $12 or $15 for a FICO score and they won't really care. So they've had tremendous pricing power to the score business. But right now, the government's creating like their own little system that could compete with FICO and could make them lose some pricing power. So that's what's kind of the bad news. But the forward PE is like actually cheap where the risk reward looks really good. They only trade at 26 times next year's net income. And look at the net income forecast. It's supposed to go to $241 million in 2 quarters. Like they've never even had a net income quarter over 200 million before. So they're literally going to be the most profitable they've ever been. It's not like forecast or bad. So honestly, this is a nice play. Honestly, you'd buy them for the earnings report. You wait 6 months for them to beat on these next 2 earnings reports. And then the stock should do pretty decent. Don't go crazy yet, but maybe a small nibble on that company kind of makes sense. I went super heavy into Microsoft. Yeah, hey, good stuff there, Looney. Well, I didn't go heavy, but I did just buy Microsoft right now. Yeah, I love a lot of the Mag 7 except Tesla. Yeah, Tesla's the only thing I wouldn't buy. I mean, Apple a little bit. Ooh, I see SoFi. What's up, Numar? He said, did SoFi hit its bottom yet? I am a shareholder of SoFi. I don't have many shares. I actually regret every share I've ever sold of SoFi, but yeah, dang, look at that. SoFi has been on a dang of a decline. And it's not just SoFi. A lot of fintech names have, Robinhood. I think it's kind of follows what Bitcoin does. So like look at Robinhood too. Robinhood almost looks identical to SoFi. So it's not not identical, but you kind of get what I mean here. Same kind of new multi-month low here. So it's not just a SoFi problem. It's kind of following what Bitcoin's doing. Let's actually pull up Bitcoin. I just want to see. Yeah. So it's kind of rhymes with what Bitcoin's doing. You know what I mean? But that doesn't make sense to me. I think SoFi in the long run is going to decouple from what really Bitcoin's doing and should just grow at its own rate. There was some news that came out today. I don't think it's going to be on here, but yeah, they're like one of the top 50 banks now in the US. Like that's huge news. But anyway, if you're a SoFi shareholder, the main metric you want to look at for growth is their financial services business because no analyst expected this sort of growth. Like they expected good 40 to 50% growth. They didn't expect it to be 70 to 100% every quarter. Check this out. Revenue's up 80%, after grew 85, after grew 114, after grew 287. Like no analyst would be bold enough to project this sort of growth for it to continue. Like it's already 500 million this quarter. Like it's so insane, the growth, it just hits a new record literally every quarter. And so same with all their other business. So they're beating on earnings every quarter. Look at that. They beat on revenue that's net income. See, they beat on revenue for the past 3 quarters in a row, and they beat on net income, and the net income is only projected to go up. It's supposed to be 200 million in 2 quarters. So that's why I think people are really starting to take SoFi serious. They really print net income. I mean, this is what you want to see for a growth stock. Revenue just hits a new record every quarter. So that's actually one. I'm certainly not selling my shares. I certainly would not be selling. The forward PE is at 22. That's what I can't believe. This is where you want to start to nibble on SoFi and really buy SoFi because the risk reward looks so good. Like if you wanted SoFi as 5% of your portfolio, you don't make it 5% of your portfolio all today, but you maybe go ahead and make it like 1%, or you know what I mean? Or just like whatever that number is for you, like a very small amount of your portfolio. Because the risk reward looks very good at a 22 forward PE. I could not see SoFi at like an 18 forward PE. And I am biased because I do own them, but I don't own much of them. I own like 24 shares. I wish I owned more, but yeah, pretty cool. All right, let's see what's next. What's up, y'all? 6-star, what's up? He said TEO. Sorry if I'm behind. Yo, happy Sunday, everyone. I am so sorry if I don't get to all these stocks. I see a ton of comments here. And yo, Jackson, don't think I forgot about you. What's up, Jackson? I do want to go over Microsoft. Let me know if you still want me to go over that one or a different one. So here is TE Connectivity stock. So I believe they're just benefiting from data centers right now. And look at the forward PE. It's actually pretty cheap. They only traded 18 times forward PE. What's up, Nick? But yeah, only an 18 forward PE, transportation solutions. It's really this industrial solutions business that's growing. Yeah, look at these year-over-year growth rates. This quarter was up 38. Last quarter, 97, 30. And if we go to the other half of the business is transportation solutions, actually this now is back to growth. This is great news. It's back to 9.99. That's the highest growth rate on the screen. It used to kind of decline every quarter by single digits. Now it's back to almost double-digit growth. So I can actually see why this company is doing pretty good. Yeah, and they print net income. They had a slight one-time adjustment, but yeah, this is the profits over time. Yeah, actually, this quarter is the most profitable quarter they've ever had. So it's actually pretty interesting. What does comments say? Does they put TE Connectivity in here somewhere? Let's see if we can find it. I know there's probably in the robotics systems here. Where is TEL? Actually, it's a cool thing to screenshot here if you're looking for some kind of stocks here. I cannot find it for the life of me. Oh, well, we tried. Well, yeah, anyway, pretty cool. They're only at an 18 forward PE. I know they do they're like an infrastructure play. Hey, what's up, Matt? So, what's up, Joel? He said TPST. Is that Tapestry? So Tempus Therapeutics, we're actually not going to cover this company. Sorry. If you look in the very top right, we don't cover this kind of stocks. If you look in the top right, they're only worth 23 million. This is a microcap that's going bankrupt. It's at an all-time low today. Let's just see if we can figure out why they're going bankrupt. This is why you always look at financials. So literally here's how you should approach these stocks. Just think about this logically. This is the market cap. This is what the whole company worth. You can buy the whole company for 23 million. So let's say you do it. You buy the whole company for 23 million. Here's what you're buying. You're buying a company that has never sold anything. We click on revenue. There's no data because they've never sold anything, not a product or service. So there's no revenue that's coming in. And you lose 3.5 mil, 8 mil, 10 mil, 13 mil. You already in just 1 year have lost more than the whole company's worth. And look at the leverage now. So they used to have more assets and liabilities. Now it's such bad news. I can see why they're bankrupt, and I bet the short interest is insanely high. So this is personally why that's why we look at fundamentals the financials when we analyze stocks, because it always explains what the stock's doing. All right, let's keep going here. What should we look at next? Hey, what's up, ASMA? Buy what? I don't know. Hey, not financial advice. Nothing in this is, but I will say my 2 newest purchases are Uber and Microsoft. What's up, Norbero? Shout out the member. Good to see you, homie. Let's do Microsoft. This is the stock I just bought for the first time. I've never previously owned Microsoft before Friday, and I just bought them for the first time ever because the risk reward is too good. It's too good to give up. This is an ETF in one. It's a software, a cloud, an AI play. So actually, they're basically they're the number 1 AI play, number 2 cloud play, number 1 software play in the world, because they have the second largest cloud market share. Anyway, let's analyze Microsoft. This is, first off, the chart looks very fair. One of the reasons they're falling is because their software name and a lot of software stocks are falling. But that doesn't scare me. And the Mag 7 is just falling right now. But basically, point being, here's why I don't think they're going to go much lower. I think the bottom is very, very close. And who cares if I don't time the bottom? Let's say it falls another 5%, but that's okay. But yeah, the forward multiple is a 20. They only trade literally at 20 times next year's net income. That's insane. I can't believe it. So here's their software business. 42% of all of Microsoft's revenue is their software revenue. Think of think of PowerPoint, think of Excel, spreadsheet, PowerPoint, all that. So that does over 120 billion of annual revenue for them. This software business just grows insane. So that does over 120 bill of annual revenue. And their second biggest segment of revenue is their cloud. Their Azure cloud, second largest market share behind AWS, also does over 110 billion of annual revenue for them. Just insane. They also sell also PCs. This is their low margin hardware business. It hasn't really grown since 2021. So that's their hardware. They've converted from a hardware business to a software cloud business. It's genius. An AI business, they have some of the best investments. They own 20% of all of OpenAI, and they have a 20% revenue share agreement where 20% of all the revenue OpenAI makes literally goes just straight to Microsoft. I kid you not. So anyway, one thing to be a question on them is kind of like their cash from investing activity spend. Like, I don't know if they're also investing in Copilot but anyway, there's a lot of bear news. I think it's got to be all priced in at this point at a 24 PE. It can't get much cheaper. You get over 1% dividend. So no matter what, you're getting over 1% of your money back just in a qualified dividend. And I think you're going to get like S&P 500 type returns, like 7 to 8% stock price appreciation every year. So that's why I just bought Microsoft. Let me know what your kind of thesis, what you think about that is. The risk reward just looks so fair, and it's a Mag 7 name. Can't go wrong. Everyone uses Microsoft. Every S&P 500 company in one way or another uses Microsoft, or their top customers do, or you know what I mean. So yeah, Norbero, good to see you, brother. Thanks for Microsoft suggestion there. Oh, Steven, what's up, dude? And what's up, the smart trader, Stalin? What strategy you follow for investing? Mainly, I just buy and hold, buy and hold great quality stocks for the long run. I don't really day trade. I don't really do options or crypto. I sound really boring, but I have a lot of fun buying and holding great stocks in the long run, and it gives great results. Like, really just boring buying and holding great stocks could give you better returns than like the option traders and the crypto people. You know what I mean? And I've been there. I used to just do options. I used to just do crypto. I used to just do cover call ETFs. I've been there, done that for like everything. But this strategy, it just always works, just buying and holding great stocks for the long run. I have multiple portfolios here, like this one right here. This is my dividend-only portfolio. Every stock in here pays a dividend. I got some great S&P 500 names like a Google, McDonald's, Meta, Constellation Energy. Here's my total percent change on every stock. So we just went total return negative on Meta. I couldn't believe it. We're now negative on Meta, negative on Carlyle. We also have a Roth IRA. Roth IRA has been struggling as well. But we just bought CareTrust REIT. It's a healthcare triple net lease senior housing nursing REIT. Pretty cool. Okay, let's keep looking at y'all stocks. Someone said, someone said Copilot sucks. All right. Yeah, Norbero. I also just bought Uber. I think Uber's a good one to buy on the dip. AppLovin. Yo, should we go over AppLovin? This is a software name. I'm now read on it. One of the best stocks to also buy on the dip right now. They've also been struggling. They print money. I might look to buy them. Ooh, A. Smith said Robinhood. I haven't done Robinhood. Let's do Robinhood. I also own Robinhood. Actually, I own all the brokerages. I own Moomoo stock, I own Webull, and Robinhood. I own all three of these brokerages, okay? I'm a big fan. And I own SoFi, and I own Dave. I'm a big fan of the picks and shovels fintech plays. Robinhood is one I'm a big fan of. Not financial advice. I'll buy the dip on. It's kind of like a pseudo crypto play. If you want exposure to Bitcoin but don't want to buy Bitcoin, you can just buy Robinhood, who collects basically royalties every time someone in the app does a Bitcoin transaction. And the most best part about Robinhood right now, as a big tailwind to their earnings, is their event contracts right here. I'm not a big fan of doing these, but if anyone heard of those prediction market stuff, like you go on Robinhood right here, and I never recommend really doing these because it's, but yeah, you can basically. Robinhood does something called a prediction market. And basically, I don't recommend doing those, but whenever you do a prediction market contract, they keep a 2% fee. Whenever you go buy and sell a stock, they keep a 0.1% fee. So it's literally 20x more valuable to their bottom line whenever you do a prediction market contract. And that's why they're pushing these. And literally, this is a cool data we get just this month. They did 3.4 billion event contracts traded. And it's just adding money to their bottom line. I kid you not. Here's basically their net income, or here's the before tax, they made 650 million. After tax, they did 605 million. This is the real after tax number. They kept 605 million in net income on 1.28 billion in revenue, which means their real net margin is a 47%. They had a little one-time adjustment last quarter. It says after tax, they made 916 mil. They had a little gap one time, realized realization adjustment. So they actually made 550 that mil that quarter. So it says the net income's negative 33% year over year. It's not actually. I just wanted to talk about that real quick. But basically, this was a record net margin of 47% net margin on Robinhood. I can't believe it. And this stock is just being dogged on because Bitcoin's trading down. But I think they're going to decouple from Bitcoin because of these prediction market contracts. Because it's just those should do resilient. Like anyway, and they have the Robinhood Gold subscription that's doing pretty good. I'm a big fan of Robinhood. I'm sure they're in the news as well. Let's actually see. Any news around Robinhood? Robinhood approves a 1.5 billion share buyback program. What's the market cap? That's over 3% of all the shares basically. So they announced they're buying 3% of all the shares. Okay. Anyway, Robinhood's a pretty good stock. Full disclosure, I do own Robinhood, so might be biased when I analyze that one, but I own them for a reason. I wish Fidelity went public. I think they are publicly traded, or maybe it's like one of their subsidiaries. I'm pretty sure they were. Isn't it Fidelity National Services? Or actually, this might not be it. This might be like one of their funds or something. I don't know. I think they have like the same like logo and everything. FIS Global. If I click on their website, is that like the normal Fidelity website? Oh, they want my cookies. You know, oh well. I don't know if that's it. Let's keep going here. What's up, Givens? I'm selling Microsoft puts. Hey, what's up, Mike? And Mike Murphy, what's up? Saying, hey, don't need no stocks. Hey, good to see you, Mike. Hope you're having a great Sunday. Hope everyone's having a great Sunday. So, what should we look at next? Barrick Mining, said Ito. Are you still holding App? I'm looking to buy him. I am, Nick. Yeah, I am still holding AppLovin. I'm actually looking to potentially buy more. So let's do Broadcom after this. Yeah, I see some good names here. So here's Barrick Mining. This is a gold play. Basically, they're a gold mining company, so they own a bunch of gold mines. And since gold is popping off right now, they're making a crazy net income. Here's the names of all the mines that they own, like Carlin, Cortez. These are the actual like names of them. Where are they? So 56% is in the US and all these other countries. So anyway, if we go to their net income right here, they print money. My goodness, they literally made $3.2 billion of net income, and you get a 1.4% dividend. So it's kind of like you get exposure to to gold. You get exposure to gold with kind of like a yield, 1.4% yield. They make net income, good, really good balance sheet. So, yeah, it's like a gold play. Nice. Should kind of follow what gold does. So Broadcom, and I see Weeble too. That's a pretty good one. So Broadcom, they make the custom TPUs. Google is one of their biggest customers. So Google uses Broadcom to make their TPUs. So Broadcom secures $970 million 5-year defense contract. Okay, wow, that's actually really interesting right there. But the forward growth on Broadcom is so impressive. Like net income is supposed to double. Like that's what surprises me. Like, yeah, you can kind of just see this based off their multiples. Look at this. The current PE is a 58, but the next year's PE is only a 28. So literally that's basically doubling. Their net income's going to double. And here's where they're getting that math from. Look, here's the net income. On the very left, it was 4.14 billion. And on the very right, it's going to grow to 11.95 billion if the analysts are right. If we go to the revenue too, look at that. It's going to be 29 billion in 2 quarters. It's going to be 12 billion in net income. If we zoom out on the net income, it's never even been close to 12 billion before. So that's why I'm so bullish on Broadcom and their forward multiple. Like it really seems very fair. 28 forward PE. Their semiconductor solutions is starting to pop off again. Look at just this growth rate right here. It's up 52% year over year. It's not like this growth rate's going to stop growing. It's going to continue to grow at this 52%. Be odd for it to stop, especially in this whole data center boom. And not just their semiconductor solutions, they also own VMware. And this infrastructure software, check out the annual growth from 2023. It was 7.64 billion, then it was 21 billion, and then it's 27 billion for the full year 2025. So they also have this VMware software business, their semiconductor TPU business. So I'm actually real bullish on them. And they print free cash flow too. This is their FCF, stands for free cash flow. 8 billion in free cash flow, 33 after grew 30. Net income's great as well. So it's 7 to 8 bill right now. And again, it's going to be 12 bill in 2 quarters. Think about that. 28 forward multiple, risk to reward looking pretty fair. All right, let's see. Pierre said EOSE. What's that one? I forget. Eos Energy. They have so many funds, but it's not the company itself. Oh, okay. Thanks for that, Matt. Okay, Fidelity is private. Okay. All right, so here's Eos Energy. I think this is like an alternative energy play. Dang, massive gap down on earnings. So they reported earnings and the stock fell like 30-40% because of it. Do they have revenue here? So, big miss. So that's probably why. So analysts this quarter expected them to do 93 mil of revenue. They only did 57 million. Kind of noticed for the past 3 quarters in a row, they've missed on the revenue expectations. And net income, they were expected to lose 57 mil. They lost 280. So it was I'm sure there was a little adjustment to that. So even if we go to the EBIT right here, earnings before interest taxes, they lost like 40% more than expected. So they had a real, I guess, disappointing earnings report. That still looks great. I mean, look at that growth. That's very impressive, but it still, I guess, came short on what the analysts expected. Perhaps they were too bullish. Actually, bad balance sheet. Look at that. They have like 3 times as many liabilities as assets. So let's see, where's the total debt here? So yeah, 8 in record debt right now. How are they going to pay off, 800 mil of debt when they're actively losing a couple hundred million more every quarter? So that's just something you got to be careful. There might be some. I'd just be careful. We just want to see them beat on their growth and start to lose less net income. So, actually, let me get to this one right here. I see Novo Nordisk. This is your weight loss company. I don't know. I actually don't think I'd buy this stock right here. And hey, what's up, Holy? Man, if you have a stock, give me like a thanks for that gift there. When then we'll look at Tempus. I think hey, what's up, Nick? Hey, thanks so much for coming to the YouTube stream. So here's Novo Nordisk right here. This is your weight loss play. They literally own Ozempic and Wegovy. But there is some bad news right now because there's increased competition and patent expiration. So they actually lose. Let's see right here. Semaglutide patent expires in India and China. Generic drug makers launch product up to 80% discount. So that's the tough part. This just happened to be here literally, and it expires in Europe and the US in like 2030 or 2028. So they're actually losing their exclusivity for their main product, Ozempic. So if we look at what this company does, 94% of the revenue is their diabetes and obesity care products. But look at the forward projections here. Revenue is going to go from 12.14 down to 10.9 billion. What app? Yeah, hey, if you want to get this app I'm on, or it's in this link tree, the very first link there on my profile there, if you want to get this brokerage I'm on, it's where you buy stocks on. But yeah, if you want to get this. But anyway, yeah, not too good. The revenue is forecasted to go negative, and same with margins are here. So anyway, it's just the forward story is very bad for Novo Nordisk with the patent expirations. And they have an inferior product. Yeah, the forward multiple is higher than their current PE. I can see why the forward PE is so low because Eli Lilly did a comparison versus they did Zepbound versus Wegovy and Ozempic, and Zepbound was the most effective. So they have a superior product. And the day that was announced, they fell like 10%. Eli Lilly was up like 5%. So it's about all the weight loss companies, and that one is a tough one. I think they're going to be pretty commoditized. If you're looking for a higher yielding play, and then after this, we'll look at Tempus AI. Sorry if I'm missing some stocks. So there's a lot of stocks, and I'm so sorry if I'm missing some of them. I appreciate everyone that's here. By the way, if you want to hit the follow button, I stream every day. Every Sunday, this exact same time. I sell nothing. I literally have absolutely nothing. I have no course book, WhatsApp designer, give my opinion. So anyway, here's Global Ship Lease. This is a shipping company. They literally own a bunch of freight ships that they ship across the ocean. They carry a bunch of cargo containers. They own like a fleet of a bunch of ships right here. And with all this basically benefits from all the supply chain issues. I think they just acquired a couple of new ships as well. But anyway, here's some of their actual ships. But check this out right here. They print net income. If we go to their net income right here, we can zoom out, and this is in US dollars. They're headquartered in Greece, but this is their real net income after tax. They really make around 95 to 100 million of net income a quarter. And the coolest part is this is a dividend play. You rarely see this. This company has a 6% dividend yield, and the payout ratio is not wrong in the middle. For that 6% dividend yield, they only have an 18% payout ratio. And I'll show you the math for yourself. So right now they're making 95 to 100 mil of net income a quarter. If we go to see how much their dividend cost exactly in their cash flow statement, where is this? Right here, the dividend in the very top right, it only costs 24 million a quarter. So as long as they're making over 24 million net income a quarter, they can afford the dividend, and they can certainly do that. Plus, they have no net debt. So it's a pretty cool dividend play, and not just a 6% dividend, but they've had some good stock price appreciation. Not too shabby. So let me do Tempus AI, and then we'll do Google. Google. So this is actually a diagnostic company. This is a healthcare play. I think they're in like genealogy, or what's this called? I forget what the exact industry they're in is called. But anyway, yeah, if we go to their diagnostics business, check this out, the number one line. Diagnostics revenue more than doubled to $266 million, driven by increased oncology and hereditary test volumes. Pretty interesting. They also have the other business, data and applications business revenue grew 25%, with data licensing surging 69%. It's a real growth company. Check this out. Like, this is super good. Revenue is up 83% after it grew 35, after it grew 46. So they're on a streak of growth. The only problem is, it's not even that big of a problem. They're struggling to get net income positive. They're still losing like 50 mil of net income a quarter. So they're losing 200 mil a year. But at the rate that they're growing, as long as they keep up this growth rate, I mean, it's not a problem for the stock. But dang, yeah, net income's supposed to lose 90 mil next quarter and 81 mil. So there's a chance if they like lose less net income than expected, the stock could soar up. But yeah, that's the problem. There is no forward PE because they're just expected to lose more and more net income. It's the only tough part. It's hard to value. But I love that top line growth. Some exposure to it's one of the better plays. Like, I'd much rather buy them than like what are the ones that Cathie Wood owns? Actually, let's just go to the Cathie Wood portfolio and check. Like CRISPR Therapeutics. Yeah, CRISPR Therapeutics. Cathie Wood owns this one. I would much rather own a Tempus AI. Oh, and she owns Tempus, huh? Check that out. There you go. Okay, anyway, let's go look at some more stocks here. Wait, what did I say I'd look at? Oh yeah, Google. What's up, Rob? Oh, and Palantir. Hey, Brian, remind me to get to Palantir. I'd love to do Palantir. So let's do Google real quick. I am a shareholder of Google. They're actually cheap. Like, you're not going to believe this when we look at their multiple, but actually, if you don't own Google, it might actually be worth checking out. Because if we go to the forward PE on the right, Google only trades for quality Google at 23 times forward PE. And for the businesses that they own, this is an ETF in one. They own YouTube. They literally own Android, the Google Play Store. They own Waymo. They have their own TPUs. They're in quantum chips. They're in AI with Gemini. They're a cloud play. Look at the Google Cloud business. They're also a top 10 cybersecurity play with their Wiz acquisition. Their Google Cloud revenue's up 47, after grew 23, after grew 28. They're the third largest cloud market share. So anyway, huge advertising business, and they print net income. This is their real after-tax net income, 30 billion in net income a quarter on average. And next quarter, it's supposed to be 31 bill, then 33 billion. So Google absolutely prints net income. Let's see if there's any weekly news here. I don't know. Gemini news. Google expands quantum computing strategy with dual track approach, targets 2030 commercial breakthrough. This is what I said. Google has the money and the talent to be the industry leader for quantum. So I'd stay away from a lot of the small cap quantum companies. YouTube projected to reach nearly 3 billion users by 2027. Leads European video market share. That's insane. Wow. YouTube at 12% market share there. YouTube partners with FIFA as preferred platform for 2026 World Cup. All right. Anyway, let's go look at some more numbers here. One thing being actually not really questioned. I mean, it's not a concern to me, but one thing to look at is how much they're spending. If you go to their cash from investing activity spend, yeah, hey, if you want to get this brokerage I'm on here, or this is a brokerage I'm on actually. It's actually, if you go to my bio, the link tree there, it's the very first link in there. It's a brokerage called Moomoo. But anyway, yeah, they spent $52 billion just this quarter. But yeah, this is my favorite app to buy and sell stocks on. If you're looking for a brokerage to buy and sell stocks on, you also get a nice 3.35% APY. It's a completely free app, costs nothing, no hidden fees or anything. My favorite brokerage. If you go to my link tree there, I have an affiliate link. If you could deposit like $100, it will both get like a free stock. But yeah, if you link tree my bio, first link there. All right, this is actually I have all these brokerages linked. Like I also have a Robinhood app. I also have a Webull account, but that one's just the best because Robinhood, you have to pay like $5 a month and stuff. And you can't even analyze stocks. Like the reason we're not analyzing stocks on Robinhood is because you can't. They don't have any way to really analyze a stock. There's no real good news. This is the best brokerage. Anyway, my opinion. All right. But by the way, I have a affiliate link for all these apps. If you want to get any of these, these are my 3 favorite brokerages. I've looked at all of them, and these are my 3 favorite. Yeah, this one is my favorite. Very first link there. Okay, anyway, let's keep going here. Sorry. Saw some people asking about that. New positions, thinking about getting into Celsius stock. Yeah, Celsius took a dip. You know what? This is so crazy. Celsius is seeing increased competition from Costco. Costco, literally, they fell on just this news. Kirkland Signature released a competitor brand to, yeah, look at this. Costco launches Kirkland Signature energy drink, competing directly with Celsius products. It's like a literal knockoff, the exact same can looking, exact same caffeine content. So anyway, that shouldn't really crush the stock because right now they have you're not going to believe this in the US, they have a 23% energy drink market market share. So they have a huge market share because they don't just own Celsius, they also own Alani. They just acquired them last quarter or 2 quarters ago. You can see their cash from investing activities. They spent $1.3 billion buying them. So Alani still owns 8.7% of all the shares. So pretty cool. But yeah, that's partially why the growth has been so insane. It's up 100% the past 3 quarters in a row because they did the Alani acquisition, and Pepsi gave them Rockstar Energy. Yeah, look at these revenue forecasts. It's supposed to go to 918 mil. They're supposed to make 115 mil in net income on that. So let's annualize that. That's going to be actually that we'll give them the benefit of the doubt, but we'll call it 400 mil. So let's do 8.7 divided by 0.4. So they trade on my earnings. Oh, this is exactly what the analysts are saying. I have a 21.75. Analysts in the very middle have it at a 21.4 times next year's net income. So that's really fair. Only 21 times next year's net income. Yeah, Celsius is looking very fair on evaluation. That's the energy drink company. Monster is another one that's kind of been falling recently, but this is another high quality one. I mean, Monster Beverage is just like been a monster performer. They also have a fortress balance sheet. Check out Monster Beverage. No debt, fortress balance sheet, and they also print net income. They're like they make 500 mil in net income a quarter. All right, let's keep going here. Have you seen USD Japan? The yen is losing so much of the value. Dang, I have not actually looked at that clip. It's unfortunate. Japanese yen trust. Oh, well, maybe is this the yen to USD chart? Look at that. I don't know if I'm even looking at the right thing there, but yikes. All right, what's next? Palo Alto or TKO? TKO is a very cool licensing and royalty company. If you like the WWE, UFC, you'll actually really find this stock fascinating because they're cheap. Like you may say like, but they've gone up so much, it's a tough buy. I really think like if you buy it now, not financial advice, it'll work out in the long run because they're so high quality. Let me show you why. Because they only trade, according to analysts, at 22 times next year's net income. Only 22 times is super fair. And look what they own. 36% of all the revenues to WWE. Then the second biggest segment is the UFC. Then the IMG worldwide. But if we go to their net income, they're printing money now. It says they only made 800,000 this quarter, but check out what it's supposed to be next quarter. They're supposed to make 153 mil next quarter and then 204 mil in net income. So it's really next year's net income you should look at. And the analysts are saying you're only buying this at 22 times next year's net income. Let's see if there's any news. They basically collect royalty and licensing rights to put the WWE and the UFC on certain platforms like Netflix or whatever. Pretty cool, actually. You also get a good dividend here. You get a 1.22% dividend. Interesting. Microsoft looking good. Yo, that's my new buy. Yes, sir. Here, I'll show you that. I'm new to trading. I have Robinhood. It's user-friendly. Yeah, hey, Robinhood is good. What's up, ants? Hey, good luck. You're new to investing. Good luck, man. Your future self will thank you for investing. The goal isn't to get rich quick. It's to build and slowly preserve wealth. It's supposed to get 10% a year on average. You turn 10 and then you snowball it. You turn $100 into 110 and then you snowball it. That 110 the next year turns into like 128 and then 128 to 158. Or you know what I mean? It has that snowball effect as you reinvest the dividend and deposit more. It just snowballs even faster. So yeah. All right. You stay away from like risky options in crypto. I kind of just like buy and hold great quality S&P 500 type companies. Like, I got, McDonald's, Google, Constellation Energy, Meta, Amazon. I got all these. So let's see who's buying Meta this week. Yo, let's actually do Meta. Yeah, this is one of the best buys also in the market. I don't see it getting much cheaper. They are down 22% year to date. It's one of the reasons we're struggling so hard. Check this out. Look at me. I love being fully transparent. Look at us year to date. We are down 10.3% year to date. So don't listen to me. I'm not an expert. The past year, we're only up 13% in this portfolio. But yeah, year to date, we're down 10%. And mainly, it's just led by these top mega caps. It's really the Mag 7 that's struggling. Google down 14% year to date. Meta down 21%. So that's two big reasons we're down so much year to date. But we're now total return negative on Meta. We're down 1.62%. But I really want to show you why I think this is a steal of a deal, not financial advice. So, a huge advertising company, Facebook, Instagram, Threads, WhatsApp, they just introduce ads to them. There is like a little bit of a legal action against them, but they got some little small speeding ticket, a $381 million charge. They make 20 plus bill in net income a quarter. So that's nothing for them. But yeah, they're actually Meta unveils executive stock option plan targeting 9 trillion market cap. I know they're cutting a lot of workforce. Meta partners with ARM Holdings to develop AI-focused CPUs for data centers. Wow, that's actually pretty interesting. So anyway, actually, here's a fun fact. Facebook, they just disclosed this about a month and a half ago. Facebook ARPU, their average revenue per user for Facebook is $50 per person. So they're making $50 per person per year per Facebook user in the US. And right now, a huge tailwind for Meta is the fact that they're now introducing ads because they also own Threads. Has anyone heard of Threads before? It's like a competitor to X. They now have nearly the same amount of daily active users that X does, and they're introducing ads to the app, and they're introducing ads to WhatsApp. They're introducing ads to WhatsApp after they acquired them a long time ago, after their original slogan was no ads, no gimmicks, no games. Now there's ads on it. Oh, well, but as an investor, I don't care. Anywho, the thing is, here's their active users. Meta literally has 3.54 billion daily active users, so half the world is on one of their apps a day, and they make every quarter 20 to 25 bill. They had a one-time adjustment last quarter, total one-time tax gap adjustment, so they didn't actually make 2.7. They actually made 20 bill that quarter. But yeah, they are being questioned for the AI spend. But I'm a fan of it. You know, their ARPU's getting better, and I like what they're doing with the Meta Ray-Ban glasses. They're getting into smartwatches. I really like the Meta Ray-Bans. I think that concept's really cool. I think also competitors are going to get in on that. Smart glasses. I think Apple, Google glasses, they're going to get in on that eventually, and Meta's the real winner right now. So anyway, the free cash flow is being depleted, but they can afford to spend it. I mean, now they have a net debt position for the first time ever, but that's not scaring me out of Meta, really. So I am a shareholder. I might be biased there, but I just went total return red on them. What do you think would be a good investment to load up before the market turns bullish again? Well, hey, that would be these kind of what I just bought right now. I really think Microsoft and Uber are two great companies, and Meta. Meta's a great one. AppLovin's a nice software name. These are all the stocks I've been buying. Oh yeah, I said I get to Palantir. This is a nice defensive hedge because they actually benefit from all the war conflict. They have a lot of revenue from the government. Let's see. Pentagon designates Palantir's AI system as official U.S. military program of record. Wow. Palantir partners with Anduril and others on $185 billion Golden Dome missile incentive. Palantir and Bain Company. Anyway, there's just a lot of good news right there. NVIDIA identifies 50 trillion physical AI market. Palantir positioned as control layer. Anywho, look at this. Here's the crazy part. 54% of the revenue comes from the government. Yo, Heel, thanks for that gift there. I appreciate you, man. The 10 lightnings. But yeah, check this out. Government is 54% of the revenue. This is the unbelievable part. The growth rate is growing. The government revenue is up 60% year over year. Like, look at these year over year growth rates in the middle. It's insane. It's up 60, after grew 41, after grew 12. So the growth rate's growing on the government revenue, and not just the government side. More impressively is the commercial side, with deals with other S&P 500 companies like GE Aerospace and Google. That's up 82%. That's insane, the growth rate. 82% after grew 31, after grew 32. So another one where the growth rate is growing. So no wonder this company's so expensive. The only bad part is they're super expensive. They traded 116 times next year's net income, but they deserve a high multiple because they have some insane revenue growth. Revenue just hits a new record every quarter. Same with net income. And another cherry on top is they're a fortress balance sheet. They have no debt, literally debt-free company, ton of cash, milking interest, collecting new contracts. So pretty cool company. And I'm sure they made a lot of money with the whole Iran or the war conflict. Hey, what's up, Mr. Golston? I appreciate you, dude. Thanks for the sub there. Yeah, if y'all wanted to follow button, we stream every day and every Sunday this exact same time. I sell nothing. I have no course book. Just only giving my opinion, so not financial advice. Ooh, I see Adobe. So, Dave app. Actually, yeah, let's do AppLovin real quick. This is another one of my most recent purchases. I am down on them just 1%. So we literally bought them. There's my buy order right there. We have 1.5 shares of AppLovin, and I'm down just 1% on them. Let me show you why this is one of the best software names to buy right now. Like, I looked at all the software names like Adobe, Salesforce, a lot of these on our dip. I think the best one to buy on the dip might be AppLovin. So if we go to the forward multiple, they're inexpensive. They only trade at 24 times next year's net income. I think that's pretty fair. But if we go to the revenue right here, it's so impressive. This quarter, they did $1.66 billion in revenue. And on this $1.66 billion in revenue, they kept, after taxes, after they paid over 180 mil of taxes, $1.1 billion of net income on $1.6 billion revenue. So that literally means their net margin, and this is real after tax and everything, is a 66%. That's a better net margin than NVIDIA. So they literally collect 60% plus net margins. The free cash flow is insane. Look how it just hits a new record every quarter. This is the growth of a company that like I want to own. And if we go to the future projections, like the net income is not supposed to stop. They're supposed to keep 1.18 billion next quarter, 1.25 billion in net income that quarter. So that's why they only trade at 25 times next year's net income. And for the growth that they have, I think that's so fair. I really think it's super fair. So yeah. And they're doing a buyback. So AppLovin, they're also might be partnering with OpenAI. I heard some rumors about that. But anyway, big fan of AppLovin. I am biased because I just bought them. But yeah. They're an ad tech company for like mobile apps. They collect a bunch of ad revenue. It's all high margin. All right, so is Microsoft a good one to invest in now? Yeah, I think Microsoft's a good dollar cost average, right? Really good. Clip said AMD. I saw someone else say AMD. Let's do AMD because I am a shareholder of them. They're kind of like second place behind NVIDIA. They're my largest holding in here, I believe. Let me see. Yeah. So I have $1,900 in AMD. I am up 60%. I bought them because I thought they were an easier double than NVIDIA. If you look in the top right, they're worth $330 billion. So the whole company of AMD is worth $330 billion. But if we go to NVIDIA, let me search by mega cap. Yeah, NVIDIA is worth $4.07 trillion. So if you buy NVIDIA now, for you to double your money, they have to be worth $8 trillion. From the law of large numbers, it's a tough double. But I think AMD could be a better total returner than NVIDIA. So let me just show you. They are more expensive, but they're having like this year is like 40% net income growth. Like look, PE right now is really expensive at a 76, but next year it's only a 45. Then the year after that, it's like a 32. So they have a good PEG ratio, price to earnings growth. It's that yearly growth rate that you look at. But anyway, this is what's crazy. Their data center revenue growth is popping off. Quarterly, it's up 39%. After grew 69%, just great year-over-year growth rates. Like obviously their data center business is going to be doing good. Same with their client revenue. That's I guess growing nicely too. But look how they've been beating on expectations every quarter. The orange line's what the analysts expect. They beat on revenue every quarter. They beat on net income every quarter. So and look at the free cash flow. This is what FCF stands for. The free cash flow is a record this quarter. It's actually really good free cash flow growth. Jeez. And same with net income. Like literally this quarter, net income was a record net income. So and a fortress balance sheet. AMD has no net debt, so it's a nice chip play. If you're looking, it's like the picks and shovels play. They sell the chips that go in data centers. So yeah, I know there's some increased competition. AMD leases Sue. Meta signed 6-year deal to deploy 6 gigawatts of AMD GPU capacity. Oh, anyway, pretty cool. So that's AMD stock for you. Hey, good afternoon, or SFG. Have you ever looked into any of the AI build out bottlenecks? Yeah, a big bottleneck for AI is, having enough electricity. All right. What's next here? Rubric RBRK. Yeah, hey, what's up, UW? So this is a cybersecurity software play. The only tough part is they're losing a lot of money right now, but they're losing a lot less money than analysts expect. But yeah, the bad news is, look at this. They're still losing like 60 to 80 million in net income a quarter, and they have more liabilities than assets. So they're leveraged. They're losing a lot of net income, but the saving grace is they're insanely, they're growthy. The top line revenue growth, the revenue's up 46, after grew 47, after grew 38. So the revenue just hits a new record like literally every quarter. It's in cybersecurity. And I think cybersecurity is it's like the best part of software because as AI gets better, hackers will utilize it and get better. And I think like cybersecurity is going to be a lot more of a defensive sector than like an Adobe, where potentially Adobe could be replaced by like, I don't know, people will just AI generate thumbnails and logos and AI instead of Photoshop or I don't know. But anyway, this is a cybersecurity play and I do like them. But you're watching the net income losses because that might be why they've been struggling. But all the cybersecurity names have been struggling. Like the best cybersecurity play is Palo Alto Network. They have the #1 market share. Like 80% of the S&P 500 use them. It's a subscription play. So yeah, look, this is a cool cybersecurity subscription play. Nancy Pelosi also owns this stock. But yeah, here's their subscription revenue. This is what you want to see. Just revenue just hits a new record every quarter, every year for subscription. I love subscription revenue and analysts love it too because it's all reoccurring and it's predictable for their earnings. And here's their net income. They make a couple $100 million net income. So they're already net income positive and free cash flow positive. So There's some cybersecurity stocks for you. CrowdStrike's another good one. Can we analyze Grab? Yeah, I saw that one earlier. My bad there, SCH. So I just bought Uber for the first time on Friday. So actually, if I show you this right here, Uber, I just bought 12 shares of them. I'm just barely up on Uber. I bought them on Friday for the first time ever. Uber is the largest shareholder of Grab. So check this out. Yeah, look, shareholder, 13% of all the shares is Uber. So they are the number one shareholder and they are the most to benefit. So basically 13% of all this company's revenue goes to Uber. I'm a big fan of Grab right here. If you're wondering what is Grab, what do they do? To keep it simple, they do exactly what Uber does, ride sharing, deliveries, but in international markets. So look at this. Notice here's the revenue where it comes from. Notice the US and Canada and the UK isn't on here. It's all these nichier countries, Malaysia, Singapore, Indonesia, Philippines, Thailand, Vietnam. So that's what's so cool. Uber's having a tough time getting into these markets. So Uber's like, let's just go buy the number one player. So they bought Grab. And I think that was genius. It gives Uber instant international diversification because they own them. And they are so growthy. Look at this revenue. And this is in US dollars as well. Revenue literally is just hitting a new record every quarter. It's at a new record high this quarter. Not just revenue, but actual net income. This quarter, they made 100 mil or 98 mil. If we zoom out, they used to lose, a couple hundred mil a quarter. It used to be a tough buy, but now they're very profitable. And then, at this growth rate, what's it going to be the same time next year? Let's see. Next quarter, it's supposed to be 80 mil and then 89 mil the quarter after. So they're a super profitable company doing what Uber does, owned by Uber a little bit of. So, but I actually am a fan of that one. And since they just got net income positive, the forward PE is still going to look a little expensive because they just got net income positive. But yeah, 39 forward PE, it's high, but that's because they just got net income positive. I think the safer buy is just Uber. But that one I wouldn't be opposed to owning because the fundamentals do look great. What app using? Yeah, hey, this is a broker I'm on a brokerage where you buy app stocks on. If you want to get this app I'm on, it's actually in my my profile in my link tree there. It's the very first link on my link tree there. Broker called Moomoo. Cost nothing, zero fees, my favorite app to buy stocks, and it is an affiliate link, full disclosure. So if you go to deposit $100, we'll both get like a free stock. Actually, funny enough, speaking of Grab, one of the free stocks I got was Grab when I first got this app. So yeah, if you want to get this brokerage, there's where we buy stocks on and get some free stocks. If you deposit $100, we'll both get like a couple free stocks. If you want to help me out, if you want to get that very first link on my link tree there. I also have all these other apps linked up there. Robinhood, Webull also have links for these apps up there, but these ones aren't as useful and they're more expensive. So because Moomoo is completely free for all the features. Anyway, let's keep going here. Yo, what's up, James? It's nice to see you live. Hey, good to see you, Ryan. I appreciate you. You buy more Meta these days? I do need to grab more Meta, but I am a big shareholder of Meta right here because I am now total return down on them. Here's my total percent change in every stock. So we're now down 1.62% on Meta, unfortunately. All right, mRNA. Let me do mRNA. Ooh, then we'll do ATI. What's up, James? And Figma. Yo, we'll do Figma too. So here's Moderna. So Moderna, this is a healthcare company. Right now they mainly sell COVID vaccines. That's like most of their revenue, but oh my, that was loud. My goodness. They're saying I'm AFK. They're going to end the stream if I don't fill out a CAPTCHA. Sorry about that. Okay. We're back. Okay, so here's mRNA. They're trying to diversify away from COVID vaccines. So yeah, that's 93% of the revenue is those vaccines. And if we zoom out, it kind of makes sense. Look, this is the bad part. This is why it's a tough buy. In 2022, obviously they were booming. They were selling billions of dollars in vaccines, but look at it now. Look at these year-over-year declines. The revenue's fallen like 80%. Look how little it is some quarters. So that's the tough part. They've lost all the growth. Revenues, look at these year-over-year declines. Revenue's down 29. Last quarter's down 45, down 41, down 35, down 65. That's after it fell 44. So terrible declines to the revenue, and not just the revenue, but also net income. Look at these losses. They lose like 800, 900 mil a quarter. So it's a tough buy, but I believe they're diversifying away. They're trying to get away from just selling those vaccines. Let's see. As vaccine revenue declined 30%. Pipeline progress includes fully enrolled phase 3 norovirus vaccine trial with data expected soon alongside advancing oncology programs. So maybe there's some oncology. That all being said, I really don't like Moderna. There's no forward multiple. Growth is really bad. So I just be careful with that one. I don't know if I trust too much money in them. But they have been doing pretty decent. So let me do ATI and then we'll do Figma. Yeah, actually, I have something to say about Figma. It's unfortunate for Figma because there's some new competition from Google. But anyway, here's ATI right here. Let's check it out. So, hey, what's up, Sermon? So ATI right here, I forget what this company does. I wonder if we can get like an analysis on them, huh? So they do high performance materials and components. So how is that doing? I guess that's flat year over year. That actually declined 0.1%. So their main business declined 0.1% year over year, but their advanced alloys and solutions, that is also negative 4% year over year. So when we combine the two businesses, revenue grew 0.38%. Net income was 100 mil. So they're still making good money every quarter. They're still making over 100 mil in net income every quarter. Huh. I wonder why the stock is booming so much right now. I wish I had some more thoughts on this one. Maybe they're some sort of data center tailwind. Metal fabrication, ARC portfolio engages in the manufacturing of specialty materials and components. Maybe we can check out their website really quickly. Interesting there. 7,600 employees. All right, let's see here. I wish I gave you more thoughts on them. I apologize. They kind of look really expensive, but they do make good net income every quarter, like 100 plus mil a quarter. All right, so let's do the Figma real quickly. Unfortunately, they have seen some increased competition from Google. It was like exactly a week ago or something. Google released an app called Stitch, and it literally does exactly what Figma does. I don't know what day it was, but they probably with this day right here, Google released an exact competitor to what Figma does. So some design app called Google Stitch. So that was some bad news about Figma. But actually, Adobe tried to buy this company right here, but regulators didn't allow it. And since they didn't allow it, Adobe had to pay Figma a free like over $1 billion on termination fee. But yeah, Figma's actually pretty cool. They do grow very nicely. The revenue's up 40% after 50%, but they're kind of in the same boat with Adobe, and they move almost identical with Adobe stock. Kind of being hurt by the long-term AI thesis. Like, will we need Figma? Will we need Adobe Photoshop in 10 years from now if we can just Google Gemini, create a logo or animation or whatever, and the technology gets that good. So that's the only tough part. But I always believe humans are going to need that final touch on art, so maybe they won't get hurt too much. But there is no forward multiple. Maybe there's just no analyst yet, and they did just IPO. But I like the top line growth on them. It doesn't look like they're profitable yet because they don't have a forward PE, which is unfortunate. I just got the VNQ ETF for dividends. Any other dividend stocks worth getting? Yeah, VNQ, this is a REIT ETF, so it owns a bunch of REITs. I actually love this ETF right here. It owns a bunch of different sectors. You know, Welltower, Prologis, that's the warehouse REIT, Equinix, Data Center REIT, American Tower Corp, Cell Tower REIT, Summer Property Group is the mall company, Realty Income, Triple Net Lease. Digital Realty is another data center. Public Storage is a self-storage one. So I love VNQ. So yeah, it's a REIT ETF, and they have a nice dividend because REITs is just a real estate investment trust, and they have to pay out by law most of their earnings in the form of a dividend. So you buy this ETF, you're getting literally over 3% of your money back in a dividend every quarter or every year. You get 3% of your money back a year. I like this ETF. I also like to pick and choose my REITs. I do own 2 REITs individually. I own Iron Mountain IRM. It's a data center REIT, and I also own Care Trust, CTRE, in my Roth IRA. So the dividends are tax-free. This is a senior housing specialty nursing REIT. Pretty cool. All right. Hey, what's up, Sermon? Yeah, we might look at Meta. I really like that one. Is Enbridge good? What's up, The Chosen? Let me actually check out Enbridge. I think that's ENB. This is like a Canadian oil play. So basically, it's like Canadians Exxon, or well, anyway, let's actually check out the earnings right here. Yeah, 24 forward PE. Oh, so they're liquid pipelines, gas distribution, gas transmission. So yeah, benefiting from the high oil prices right now. And mainly it's a dividend play. You get a 5.03% dividend yield. So let's see how much the dividend cost. I mean, oh wait, first off, this is in Canadian currency. So let's convert that to US dollars. So now we're looking in US dollars. Their dividend cost every quarter in the very top right, 1.58 billion in net income. So as long as they're making over 1.58 billion net income a quarter, they should be good. Sometimes it's not. I don't know if those are one-time adjustments, but anyway, the stock seems to be doing great because of oil prices. It's kind of like an oil proxy. So congrats if you own that one. Oh yeah, hey Pat, remind me to get to SoFi. We'll check that one out too, and then we'll do these other ones. I want to get to Wix really quickly. This is it's like a e-commerce company, kind of similar to Shopify. They also are a vibe coding play, but it's so commoditized now. Like there's a bunch of vibe coding websites where you just type in a little prompt and it creates your whole website for you. So that's the only tough part. And oh yeah, they've been missing on these net income projections. Look at that. Analysts expected them to make 16 mil in net income. They lost 40. So I used to love this company because they really used to make good net income. They were super profitable, making 50 mil in net income a quarter. But now analysts are even projecting them to lose net income next quarter. And it's just the profits have been getting whacked. I mean, the revenue growth is still super good. Revenue is going to just hit a new record every quarter, but I guess it's a net income problem, and it really hurts their forward multiple. Yeah, only a 64 forward PE is tough. So, that's the only bad news is these net income losses have been a surprise. That's why they've been gapping down on earnings day. But I still love them as a vibe coding play. They own like base 44. It's like one of the best ones. So what is CRS? So this is Carpenter Technology. Wow, look at this stock right here. What's up, Ito? Appreciate you. So Carpenter Tech is at pretty close to all-time high. They've done phenomenal. Let's see what they do. Specialty alloy operations, performance engineering products. So what actual mineral do they mine? Metal fabrication, huh? You know, they might some alloys. So it listed them at the bottom there. What were they? So they include Dynamet, titanium. I don't know. I know like tungsten. A lot of these precious metals have been booming in actual price. Like even boring commodities like aluminum and gold and silver. We've all in copper have seen a nice boom in price. And I'm sure this like specialty alloy company, there's a big price in whatever commodity they mine. Some tungsten alloy thing. I don't know. But yeah, look at the profits that's going to happen. It's only up and to the right. It was 155 mil 2 quarters ago, and it's going to go to 200 mil. Revenue is going to go to 840. So they're already printing net income. They're already super profitable. And you get a dividend with this company. Interesting there. I'll put them on the watch list. They've done like as good as Comfort Systems. Hey, Lulu, thanks for the gift there. Thanks for showing up. I appreciate that. So what's next here? Do you think Snapchat will hit a bottom this year? Yeah. Hey, what's up, Newmar? So the bad thing about Snapchat is the shareholders don't get any voting rights, and the net income that they lose is almost directly looks like the stock-based comp of the employees. So that's the bad part about Snapchat. They're not consistently making net income. Like they're losing a couple hundred mil in net income a quarter. But now the good news is they did actually get profitable this quarter. They made 45 mil in net income. What are analysts projecting? So next quarter, they're supposed to lose 142 mil and they're supposed to lose 191 mil. Like I just don't love that they're losing that much net income. And if I was looking for like a social media app to really buy on the dip, I would actually buy Reddit, and I literally just bought a share of them on Friday. There's my little buy order right there. I actually love Reddit. They're growthier than Snapchat. They have a better ARPU. Snapchat isn't monetizing right. Like they can't actually make good money off despite having a ton of what is this? Dolby Laboratories files patent infringement lawsuit against Snapchat over video. Okay. US Senate requiring large social media platforms to provide. Okay. Yeah, there's a lot of lawsuit news. Like with Meta in a lawsuit, Snapchat's also in trouble for this. So yeah, they've been taken. Anyway, they're not exactly cheap on a forward multiple because there is no forward PE because they're still not supposed to make any net income. Yeah, here's their active users. They have 474 million daily active users. So they have a ton of daily active users. But yeah, it's a tough one. It's really a tough one. Tencent is the largest shareholder of that Chinese company. Interesting. Any tips on how to diversify portfolio? I'm struggling with that a little. Yeah, you just want to have a little bit of every sector, own some defensive sectors as well. Like maybe get a utility in there, maybe like an insurance name, a healthcare name like an AbbVie. AbbVie is one of my favorite plays. You get a good dividend at 3.3% dividend with good growth as well. Get Microsoft, try and get a bunch of different sectors. So like some people think they're diversified when they just own like Meta, Google, Microsoft, but it's like all three of them kind of move somewhat together. Like you got to diversify across different sectors, but don't over diversify. Like you don't want to own too many stocks. Like right around like 25. After you get over the 25th stock, like the bell curve of diversification, you're not actually statistically diversifying yourself anymore. It's called diversification. So really don't get over that many stocks. Okay, anyway, let's keep going here. Really over like 20 is a sweet spot. Um, QQQI, not bad for dividend. That's a covered call ETF. So yeah, if you're looking to maximize your income, this is QQQI. You don't buy for the stock price appreciation. Like since its inception and it's been flat, but you buy this to maximize your income because it pays you a monthly dividend of a 15% yield. It kind of changes every quarter. It's not even a dividend. It's actually a distribution because they're not dividends. It's option income. So you're getting distributions. You get a monthly distribution every month. But yeah, you buy this to maximize your income. You're not going to total return beat the S&P 500, but you buy it to maximize your income. Yeah. So, okay, let's do Webull now. Let's do ServiceNow right here, and then we'll do ATI produces the components and rare earth minerals that are used in weapon systems. Oh, hey, thanks for that, James. Interesting. And we'll do ICU and hey, Outwork. What's up, man? I appreciate that. Yeah. Let's actually do ServiceNow. I see Webull as well. Yeah, if you got any stocks you want to look at, let me know. We'll definitely check them out before I go here. But yeah, this has been fun. I stream every Sunday this exact same time. So here's ServiceNow. This is a phenomenal software name, one of the most high quality software stocks to buy on the dip, So if you look at all the other software names, they're all also on the same dip, like Adobe, Microsoft. They also look very similar or have done also very poor, but it's not like they're missing on earnings. Like their fundamentals are great. So let's see down here. Yeah, they're big subscription revenue. Subscription revenue grew 21% to 3.5 billion, exceeding expectations. But look at this. They have a contracted backlog. So a backlog literally in contract that increased by 25%. Like after fulfilling some of the backlog, the entire backlog still grew 25% to 12.85 billion, with large deals and customers with ACV over 5 million expanding notably. That's actually insane. So spending 5 million or more as customers exceeding, look at over like, I think like 60% or more of the S&P 500 use their software. Revenue just hits a new record every quarter. They're a subscription model company. They're printing net income. Yeah. Like look at revenue growth over time. Like there is no dip. It literally just hits a record every quarter. So that's why I think a lot of people like this one, and not just the revenue, but also net income. They're already profitable. A lot of software managers still struggling to get profitable, but not this one. They're already making like real after tax, like 500 mil a quarter, and it's only supposed to go up. So that's my thoughts on ServiceNow. They look a little expensive, at a 42 forward PE, but that's because they're really just getting net income positive. So they are a little bit expensive, but they deserve an expensive high multiple because they're so quality. So they're really at like their fair price right now. Like I think this is a very fair price. If you wanted this as like 5% of your portfolio, don't make it 5% today, but maybe go ahead and make it 1%. Definitely don't go all in, but dollar cost average. Ooh, Amazon too. Let me do ICU, then we'll do Webull and Amazon. So here's ICU, C-Star Medical. So yeah, we want to be really careful with this one, Will, or just because like, hey, Tingrika, no way. Thanks for all those roses there. I appreciate that. Hope you're having a great Sunday. Good to see you. Yeah, if you look at the top right, this company is only worth 10.9 million. So that's just a very small company. Hard to really trust something in the long term that's only worth $10 million. And kind of think about this logically. You buy the whole company for $10 million, where you're buying a company that unfortunately, loses a couple mil a quarter. It lost 3 mil, 3.5 mil, 2 mil, 3 mil. That's a big, that doesn't seem like that much money, but when your whole company is worth $10 million, 3 million is 30% of the whole company. So, yeah, not one I'd really trust. It's unfortunate. I think there's some real bankruptcy risk there just because they're so tiny. So let's do Webull real quick. So this is a brokerage I do own in stock. So here's my actual Webull account. That's where I just bought my Uber stock. The reason I like Webull stock right now is because they're getting in the very top left. It says new next to it. They just added in right around after they IPO'd prediction markets to the app, which is making Robinhood a lot of money. They're basically copying the super success of Robinhood. And they also just added in crypto. So you can now buy crypto on the app as well. So they're just like basically copying everything that Robinhood's doing, and it's working. So I'm just personally more bullish than the analysts are on their future earnings. So it's as simple as that. Let's see if there's any news around Webull. Probably not, but I'm just more bullish than the analysts are. And I think the risk reward just looks very fair. They're so tiny. I mean, only a $2.5 billion company And they think even the analysts think it's at a 25 forward PE. Yeah, or a 31 on the very right. They only trade at 31 times next year's net income. I think it's like a 25 based off how I think they're going to beat on net income because of their prediction market stuff. So you look at the top line growth. Revenue's up 49%. Last quarter grew 55, then 46. I think it's going to continue that growth. So anyway, I think one of the reasons why the stock is struggling so bad, like look, it's at this new like all-time low. It's not just a Webull issue. Like their biggest competitor, Robinhood. Look at that. Robinhood hit an all-time, or not all-time low, a multi-month low as well. So the charts almost look identical. But yeah, Webull, I think it's a better deal just because they're so tiny. Only worth 2.5 billion. I love the prediction market stuff. So yeah, 31 forward PE. I think it's cheaper. Hey, what's up, Eric? And Mayan said Caterpillar stock. Wait, let me do Amazon, or actually, I'll do Caterpillar first. Let's get to Caterpillar. That's actually a great dividend growth company, surprisingly. I think they're just going to continue to climb higher. Yeah, look at this. Caterpillar stock, even though they've already done so well, I think they're just going to continue to do well. Like if I was a shareholder of this one and I was up a bunch, I would not trim or sell this one. I just continue to hold it because I think they're just going to continue to climb higher. They make, they're like a data center infrastructure play. They make these huge power and energy generators that have to, like under every data center, they have to have this huge diesel generator because in case the actual electricity grid goes out, these data centers can't afford to go online. So they always have backup huge generators under them. A lot of them are made by Caterpillar. So power and energy is 50% of all their revenue. Then there, the heavy machineries, the construction industry who use Caterpillar heavy machineries. Crazy new construction boom in the US thanks to tariffs and reshoring back to America and stuff. So the construction business is booming. Also the resource industry, a lot of mines are being opened right now. That's when, so there's like a bunch of tailwinds from many sectors that's just going to benefit Caterpillar. So I wish I was a shareholder of this one. I want to get into this one. They have a 0.85% dividend yield. My pseudo play to Caterpillar is actually just United Rentals because they own a bunch of fleet for them. And maybe it's better to rent instead of own one. Or anyway, I have United Rentals as a similar play, but Caterpillar's done way better. Congrats if you own that one. Okay, let's do Amazon real quickly. Yeah. What's your take on Plug Power? And not too big of a fan of Plug Power, but we'll check it out just because I think there is some bankruptcy risk with Plug Power, but I do like going over that to kind of teach that. But this is one of my favorite stocks to buy right now, not financial advice. I am only up 1% on my Amazon position, or certainly at least put this on your watch list because you won't regret buying Amazon for the long run. It's a literal ETF in one. I mean, it's literally a cloud play, an AI play, robotics play, e-commerce play, subscription play, advertising play, drone play. Like they own 10% of Rivian. Like I'm so bullish on Amazon, and they're a margin expansion play. Check this out. They're like a UPS, an Oracle, an Instacart, all in one. Like here's their net income. This is crazy. And if we zoom out over time, their net income's only getting better. Actually, they had a slight one-time adjustment. The profits were actually at a super record this quarter. If we zoom out, this quarter specifically was the most profitable they've ever been. And if you go to the revenue right here, they're actually the number one Fortune 100 company by total revenue. There's no other company in the world that exists that does more yearly revenue than Amazon does. It used to be Walmart, but Amazon just took it over. So yeah, they do like 150 to 200 bill of revenue a quarter. They're the number one cloud service provider. So AWS is a huge business for them. It's their number one highest margin business. They're not making too much net income shipping you the same day package, but like low margin. But this AWS is super high margin, just data centers, no employees needed. That's why a lot of companies are spending on data centers because like it's GPUs, it's robot, it's basically like robots doing work. Like you don't have to hire employees to run a data center. Well, like a few, but it's the GPUs doing the work. But yeah, AWS, there is only going to see more demand. Let's go look in the news right here. I know there's a ton of news for Amazon. AWS accelerates AI. Amazon acquires Fauna Robotics. I was on their website. It's very cool. Amazon Zoox to launch robotaxi. Yeah, they have their own robotaxi. I was in Vegas and I saw the Amazon Zooxes and Waymos everywhere. Oh yeah, they're raising their ad-free tier price to $4.99. Has anyone heard of the Mr. Beast games? They're actually huge on Amazon. One of their biggest hits. Mr. Beast was originally going to put his Mr. Beast games on Netflix, but Netflix didn't give him the final touch rights to the editing. So, and Amazon did. So Mr. Beast went with Amazon, and actually Amazon has made so much money because of it. They're actually like way up on their investment because of that. Amazon invests $4 billion to expand 2-day delivery network to rural America with 200 new hubs. Like I love that. They're now better than UPS. They're the number one postal service, like better than USP. And anyway, I could go on and on and on about Amazon. I am a shareholder. I might be biased, but it's one of the best buy and never sell stocks. So, hey, what's up, Monkey D. Luffy? Let's AppLovin, please. Yeah, we'll look at AppLovin for sure. Let me look at that one next. Xanatech. Hey, Adam, give me the ticker symbol. I've never heard of Xanatech. If you give me the ticker, we'll definitely check it out. Hey, like your study on the stocks, quick and down to the T. Hey, I appreciate you, Mayan. Which sector do you give most bullish on given the circumstance? Probably just like tech, big tech, like Microsoft and Amazon and Meta and Google. That's why I think the bottom is so close. All the valuations are extremely cheap. Like I just bought look at that, like just losing streak, just like 15 days in a row after having anyway, I'm buying a bunch of Microsoft, or I just bought Microsoft for the first time ever on Friday. I bought Uber as well. So, and software is a big one. Like Tingrika, good to see you, said AppLovin. This is one of my favorite stocks to buy. Let me cover this one next because we did just analyze him a minute ago. But we'll do that one next. Thank you so much, Tingrika. And then we'll look at Micron too. Luffy, what's up? He said Micron. Yeah, Micron. There's a memory shortage play. Let me do DoorDash real quick. I saw that one. Yo, what's up? FNS said DoorDash right here. Yeah, a good consumer discretionary play. They just acquired Kangaroo, a huge Australian food delivery service. It's called Deliveroo. They just acquired them, which is pretty cool. Let's see if there's any news right here. So total order increased 32% to 93 mil. Gross order value rose 39%. So pretty cool. Let's go check out the revenue right here. I know there's a lot of increased competition, from Uber and stuff, but look at that growth. This is what you want to see if you're looking to buy never sell a stock. I will say I did just buy, Uber for the first time ever. So I chose to buy Uber instead of DoorDash. But yeah, this growth is still really impressive. Let's see, revenue's up 38%, and they're super net income positive. They're easily making 2 to 300 million of real net income a quarter. So they're printing net income and free cash flow, 2 to 500 million of free cash flow a quarter. So what's the forward multiple on DoorDash? It's a 55. So Uber, to be fair, Uber trades at 20 times next year's net income. DoorDash is at 55 times, so a lot more expensive. And where does the revenue come from? So 82% US, and they'll actually grow their international and Australia revenue. So anyway, I think I'd rather go with Uber stock. I might be biased, and I only think that because I just bought them. But yeah. Let me do AppLovin. Is it true that there's 5 million purchased to Uber last week or something? I don't know. I have not heard that news, so I can't verify that or something, but I'd believe it. So here's AppLovin right here. This is your advertising. It's like a mobile advertising company. They're saying one of the days they fell is when Google released this new gaming platform, but it's not even going to hurt AppLovin because it won't hurt their ad business anyway, which is 80% of the revenue. They also have that game business that Unity and AppLovin are in, but 80% of the revenue is ads, and it's the best. Check this out. Anyway, let me just show you why I love this stock. Their fundamentals are so strong. The revenue was 1.65 billion, and on this 1.666 billion of revenue, they kept the net income after tax 1.1 billion after they paid 180 million of taxes. So they really did keep 1.1 billion net income. They kept 1.3 billion free cash flow, which means their net margin is a 66%. So you go spend $100 for their ads, they keep after tax $66.48. And the net income's only projected to go higher. It's 1.18 billion, 1.25 billion. So that's what's so insane, to the point where the forward PE is only at 24. They only trade at 24 times next year's net income. That's what's so insane about AppLovin. So yeah, I do own them. I'm a super happy shareholder. This one I am down 1.5% on them, but I'm just so bullish on AppLovin. I don't think they're going to get much cheaper. Yeah, 24 forward PE on AppLovin. It's a great software name. And again, they're falling just because all the software names are falling. All of them are at a new 52-week low, like Microsoft, Adobe, and ServiceNow, DoorDash, Uber. They all are struggling. So any small cap you're looking at? Not really. Yeah, I haven't found any really interesting new small caps. I mean, kind of, well, I guess they're worth 2.2 billion. There was a big short report. Like the only reason the stock is selling because there was a big short report. But actually I won't even cover that stock because they're so risky. It's not even worth covering. Yeah, not really. How's Lightpath? This one's an interesting one. They're worth $550 million. So this is a micro or pretty small company worth 550 mil. I love the growth that they have. Check out the revenue right here. Like this is why I think this one's really interesting. The revenue growth is really good. 16 mil this quarter. They're still losing money though. All right. They're like infrared components and stuff like that. All right, let's keep going. Hey, what's up, Dr. Dummy? And yeah, Amazon stock has underperformed the market in the past year. Why is that? Well, everything's underperformed. Actually, Amazon hasn't underperformed the past year. I think Meta and Google have done worse than Amazon year to date. But I don't know. They've all done bad. Oh yeah, Micron. I said I'd get to Micron real quick. Yeah, Luffy. Let's do Micron real quick. So this is your memory shortage play. I love Micron right here simply because the forward multiple just seems so cheap. Like look at this. The forward PE is only a 3.9. So the analysts are saying this stock only trades at 3.9 times next year's net income. Here's where they get that math from. They're supposed to make next quarter 21.9 billion net income and then 25 billion the quarter after. Like, look at it. This was already a record quarter. 13.8 billion was a record, but it's literally going to jump all the way to 25 billion in 2 quarters because of this whole memory shortage issue. So that's why they say the forward PE is only a 4. So, 25 billion a year annualized is 100 bill. 100 bill of after-tax net income a year, the whole company is worth 402 bill. So that really is only 4 times next year's net income. I really feel like this could stretch up to like a 8 or a 9 forward PE. Global CPU and memory shortage intensifies as Micron describes RAM supply as extremely severe. Forecast RAM and memory prices to surge 130 and 150% just in the first half of 2026. So yeah, it's rough. Any other news? Okay. Anyway, yeah, Micron, I think the risk reward looks really good. That's your main memory shortage play. It's really a sentiment play because like if the shortage just fixes out of nowhere, stock will probably go down. But the fundamentals, like the forward PE seems so cheap. It's a nice little like buffer, Let's see. Do you think I should start some positions in energy or gold mining companies? Like, yeah, I like some energy companies, Constellation Energy, Vistra Energy, Southern Company. Yeah, these data centers all got to get powered. And this is the number one nuclear play. Specifically for energy, I like nuclear. And this is the number one nuclear play. They literally own over 30% of all the US's nuclear reactors. So it's the number one, or the purest play for nuclear energy out of any stock that exists. So yeah, CEG is a really cool nuclear play. You get a 0.5% yield. They do share buybacks. They do M&A. I'm a big fan of CEG, and I am a shareholder, full disclosure, but I own them for a reason. I'm still up 45% on them, but I really like them. All right. Let's see what's next. Yeah, hey, I have unpopular opinion. Anything Microsoft, Skype, Xbox. Wait, anything Microsoft didn't work. Hey, Xbox is really good. But yeah, Skype, Windows Phone. Those are all like old little experiments. Wait. A lot of stuff Microsoft touched has done phenomenal. Their software business, their cloud, their AI. But that's just some part of Microsoft. Yeah, that doesn't worry me at all. Do you think Microsoft is close to the bottom? Absolutely. Microsoft is super close to the bottom, I think, because the forward PE is only at 20. They only trade at 20 times net income. Microsoft owns so many other stuff like you won't even know. Like they own LinkedIn. Like Microsoft owns LinkedIn. Like they own Minecraft. They bought Minecraft. So actually, here's one thing Microsoft had one of the best touches on. Microsoft bought Minecraft for $1.1 billion. And now just Minecraft does well over $1 billion of just revenue a year for them. Like the Minecraft movie, like Minecraft is one of their best ever investments by Microsoft. So yeah, if you buy Microsoft now, you get a 1% dividend yield. So yeah, pretty cool. Ooh, Microsoft did fail to make their own like streaming service too. All right, let's see what's next year. They like hired Ninja to work for the streaming service, but it just never worked. Okay, someone said Oklo. Yeah, not a great nuclear play. This is an SMR play. Actually, I won't even cover this one. I just recommend not buying this one. See, it's doing exactly what I thought I'd do. Just slowly go lower because it's not a good or quality company. Say it's a startup. with no revenue. If you go to the revenue, it says zero because they've never sold anything, not a product or a service. They're not expected to make any revenue anytime soon, and they just burn through a ton of net income every quarter. So this is a small modular reactor play. If you didn't know, I really stay away from the small modular reactor nuclear stocks. There's only 2 working SMRs in existence, and neither of them are in the US. So this is a whole proof of concept, no revenue till 2030. Just a huge future story. It's a tough one to buy in my opinion. Tough buy in on Oklo. I'd go with CEG, Constellation Energy. Bought some Microsoft and Micron and AppLovin on Friday. Yo, those were great choices there, Monkey D. Luffy. Do you think Tesla will dip? Yeah, I don't even focus on Tesla. Yeah, Tesla's like high beta, but the thing is, I want Tesla to do good because Tesla, like, if Tesla's doing good, a lot of other stocks it's propping up a lot of other stocks to do good. It's kind of like a measure on how beta the market's feeling. It's never a stock I'd own individually. The multiple is just too insane. And I've looked at the 2030 EPS projections. They're expected to make so much money from robo-taxis and robotics, but I just don't believe it. It's going to be so commoditized. Like Amazon, Google Waymo is already beating them in robo-taxis, and Amazon's beating them in robotics. So it's just like, I don't know. I just can't buy. If you buy the story of Tesla, you'll buy the story of Google, Meta, and Microsoft even more, and they're extremely cheaper. Like their Tesla really is priced for perfection, and they lost their growth too. Like their car sales are negative. Like Tesla's in negative growth territory. Actually, that's the unfortunate part. Like, or maybe the growth just came back. Let's see. Yeah, look at this. Literally, the lifeblood of the company's revenue, the sales, it's literally negative 3% year over year, and it's not just the revenue. So the revenue is -3, the net income is -60. What does that mean in English? That means your margins are going down after they just lost their EV tax credits. Look at the net margin. It used to be respectable. It's not like just a one-time adjustment either. Like this is real. They used to make a respectable, 15% net margin a quarter. But for the past 4 quarters in a row, it's like super low single digits. So it's a margin collapse, unfortunate. So anyway, it's a tough buy on Tesla, in my opinion. But let's see if there's any news here. Tesla, SpaceX, and xAI announced a $25 billion terafab semiconductor in Austin, Texas. Kind of cool. Anyway, it's just too expensive. Let's see what their multiple is. So if you buy Tesla today, you're buying them at 269 times next year's net income. Just too pricey. Like it's a stock I'd maybe want to own if it just wasn't extremely expensive. You know what I mean? But yeah, the growth, the sales were negative year over year. It's just too expensive for the growth, for the negative growth. And I mean, Microsoft and Google and Amazon, they're growing more and cheaper, and they're going in the same industry. Like if you like, I think Tesla's going to be the best robotics play, and I think they're going to be the best robotaxi play. Like I also think it's worth putting some money into Amazon and Google. Like no brainer. Okay. Anyway, let's keep going there. Sorry, I didn't mean to be too bearish on Tesla. Probably lost some viewers there because I know that one's really liked. But I always be honest. That's all I try to do. Be really honest about every stock. And another one I'm not going to be too bullish on because I'm really scared about this stock too was UNH. They're basically in the government's hands. This is that Medicare, Medicaid stock. And they were caught overbilling. Like every time we're overbilling the federal government. And so the margins will never be the same. The reasons their net margins were so high in the past is because they were overbilling the federal government in prescribing people that back brace they didn't need. But now the government has figured it out, and the margins have basically collapsed. So that's the bad news here. So like, actually, we're a customer, we use OptumRx. So we're a customer, and this business is growing like crazy, but it's just a margin issue for UNH. And it's just kind of too much in the government's hands for me. So here's the net income. Like the same time, well, they just have been missing like crazy on net income. Look at this quarter. Expected 1.5 bill. They only did 10 mil they only did 210 mil of net income this quarter. So the net income has fallen quite a bit. It basically, look, gross margins, basic metric here, gross margins down 22 after it fell 10. So gross margins are down bad, and even net margins are down bad. So it's kind of just a margin issue here. But the good news is Warren Buffett bought the stock like a couple months ago. Warren Buffett's a shareholder. But it's just too regulated for me. It's like every time they fall, it's not because of earnings. It's because the government does or doesn't allow them to raise or lower, or doesn't allow them to raise prices like they think or whatever. I don't know. UNH is I'm just staying away from that sector. Even if that stock goes up, I won't feel bad if it goes up. It's not like it's some super sexy, attractive stock everyone wants to own. Like it's a boring, low margin Medicare, Medicaid, like something every company has to just deal with, like that no one likes them, or you know what I mean? Like here's where this is their peak margin back in the day, a 6% net margin. But they're not going to get that same margin if they get accused of fraud. Or anyway, I'd just be careful with them, watching the margins. I can see why they gapped down on the earnings day. The reason they gapped down specifically on earnings day right here is because remember, it was so aggressive. It was an aggressive down. They went from 350 to 250 basically. It's because they missed so aggressively on their net income. It wasn't like some one-time adjustment either. Here's their earnings before interest, taxes, their EBITDA. They expected 3.3. They did 380. It was a huge miss on profits. So we want to see them not miss on earnings like that again. Oh yeah, hey, I believe you already discussed Novo Nordisk. Yeah, I can cover Novo Nordisk again really quickly. This one has a pen. It's basically a future sentiment play. The future is not looking too well on this company because of their patent expiration. So if you've heard of Ozempic before, they have that patented. It's called semaglutide, and their semaglutide patent expires in India and China. Generic prescription makers launch products up to an 80% discount from them. They're also seeing increased competition from what's it called? Zepbound. And Zepbound from Eli Lilly actually performed better than both Ozempic and Wegovy. So yeah, this is your pure weight loss play. Look, 94% of the revenue is their diabetes and obesity care. I wouldn't be opposed to maybe putting a little bit amount of money into this one, but I wouldn't put a meaningful amount of money into this stock simply because of that future thesis. Like their patents are going to expire. Probably these weight loss prescriptions are going to become very commoditized and the price is just going to go down every time. They actually recently said, we just cut our prices of Ozempic to hopefully stop people from buying knockoffs. As we lower prices, people will just stop buying knockoffs, they said. That's why the forward PE is actually higher than the current PE. And I think they're at like this low 10 times multiple because the increased competition. Like look at the growth expectations. The revenue is going to go from 12.18 and it's supposed to fall to 10.99. So revenue sales lifeblood of the company is expected to go negative like 20% year over year. So revenue's falling. It's a tough one. And that patent expiration, I can understand why the stock has been beaten down so much, but also that's why the stock has been beaten down so much. Maybe it's fully priced in. Maybe the worst is already over. But that's why I would just be careful because I can understand why there's some fear around that name for the thesis fear. Also, some other companies are getting into weight loss. Like AbbVie is working on their own weight loss prescription. It showed some positive results. Wonder if I can. That news isn't going to be on here. Also, Metsera was just acquired by Pfizer. Wonder if I can still find their stock. Metsera. They're already delisted now. Yeah, MTSR is now delisted. This is a weight loss stock that was just acquired by Pfizer. All right, let's look at some more here. What do you think about Meta? Do you think it'll drop further? I don't think Meta will drop further. Yeah, hey, no problem, Scott and Peyton. No problem there. Let's see what's this say? Apple still maintaining green when the CEO retires. Really? Did the Apple CEO actually retire? I wonder if that's true. Apple to source iPhone parts from Bosch. Apple discounts 6-figure retention bonuses for engineers. Apple plans to introduce advertising in Maps application. You know what I think is going to be interesting? Google Maps. Google Maps just got a huge update, and I think Google Maps is going to integrate with Waymo, which would be pretty cool. You like book a Waymo through Maps or whatever. But anyway, yeah, Apple has really been rewarded for not spending so much on AI. Like Meta, Google, they're spending like $50 billion a quarter buying GPUs. Apple is literally buying no GPUs. They don't have that heavy CapEx spend that all the other Mag 7 is. So, and they print net income. They have the number one buyback program on earth. They buy back 100 billion of their shares a year. I have so much good stuff to say about Apple. 60% of their sales are their iPhone business. Then the services revenue. This is the real good winner here, their royalty revenue income. Whenever you go buy something in the App Store, they collect either a 25 or a 30% fee, developer fee. It's all just high margin. That does over 110 billion of annual revenue for them. Then the iPhone sales are starting to recover again. And look at this. This is the before tax. Before tax, they made 50.8 bill. After tax, they kept 42 bill. So they really kept 42 billion in net income after paying taxes. And what do they do with all that net income? Well, first off, they pay a dividend. That's why I think they're going to be a great dividend growth company. The dividend every quarter only costs 3.9 bill. So they can pay for the entire year of dividends just in one quarter, in like half a quarter. And since they have so much leftover money, what are they doing with it all? Share buybacks. Look at the top, literally 20 to 25 billion of share buybacks a quarter. So they've been, and just for all of eternity, we can scroll back all the way to like 2020, for just all of eternity, 2019. They're always buying back like 20 billion of the shares a quarter. So they buy back like 5% of the stock a year, plus you get a 0.5% dividend yield. It's a phenomenal never sell stock, in my opinion. And a lot of people are like locked in the Apple ecosystem. I'm on an Apple iPhone. A lot of people like the AirPods and the Mac and the Apple TV. It kind of all seamlessly goes together. So yeah, big fan of Apple. They have a lot of pricing power. You know, a lot of people actually, there was like a statistic, more people would rather like at all time, like have access to a phone than a car, or like, it's like a phone is one of the most essential things in a person's like everyday, like just to live. It's like it has to be a part of you. Don't try and catch a falling knife. Exactly. Don't try and catch a falling knife, but certainly buy stocks that the risk to reward looks very good on, you know, dollar cost average into them. Like Microsoft's one, you know, I don't see it as like, it's definitely falling, but I don't see it falling much more. But yeah, don't definitely try and fully catch it, you know, for sure right now. And spend all your money right now buying the dip, because it could maybe fall another 5% more. Hey, what's up, Catherine? Yo, what's up, Silver? If you could buy one stock, what would you pick up? Meta, Microsoft, Visa, MasterCard, JP Morgan, McDonald's? You could only buy one of these stocks next week. Well, I'd probably just buy more Microsoft, because literally if I just bought them for the first time ever on Friday, so Microsoft is my newest position. But just to keep it fun and not answer that one. Oh, McDonald's is also really looking good. I'll go with Visa. Visa's a very attractive stock there, Marcus. And hey, what's up, 6-star? Yeah, let's look at Meta after this too, I think someone said. And then QUBT, maybe we'll cover that one. Yeah, Visa, the risk reward looks very fair in my opinion. A lot of fintech stocks are being hurt right now. It's not just, you know, Visa, it's also Circle and wait, what is this right here? Visa becomes first major payment company to join. Okay, I don't know what that is. Wait, what does this say? FTC warns Visa against denying service based on political or religious views. Oh, so they can deny people based off. Okay, well, anyway, I don't know what that's not a big deal. Anyway, the reason I like Visa is because they're very fair on the very right. They only trade at 22 times next year's net income. For the quality that Visa has, I think 22 times forward PE is very fair. Everyone has a Visa card. You know, those small little micro credit card transaction fees that are slowly bankrupting us are making Visa a lot of money. And here's their real after-tax net income. Every quarter, they're making $5 billion in net income a quarter. And what's Visa doing with $5 billion net income a quarter? Again, it's another dividend growth company where they pay a dividend, and look how little it costs. It only costs $1.3 billion a quarter. Since the dividend costs so little, they're spending all their leftover money on share buybacks, and that's my favorite part. Visa buys back like 4% of the stock. Here's how you can tell. The net income grew by 14, but the net income per share is up by 17.4 because 3.5% of all the shares are gone. That's why it grew 3.5% more. Plus, you get a near 1% dividend yield that they raise every single year, way faster than inflation. It's a phenomenal stock. I think if you buy Visa now, you should get like 8 to 10% of your money back a year, or whatever, like S&P 500 type returns. Very big fan of that one. Great net income. So, yeah, that I really like that one. Would Apple do another forward split? Yeah, they could, or a forward split, or yeah, stock split. Yeah. Maybe. I think they're still too cheap. Yeah, 250. They'll probably do it at like $500 a share. They'll do a split. Powell Industries is doing. This is my first ever stock that's doing a split right now. Powell Industries is $538 a share. They're doing a 3-for-1 stock split, so I'll basically 3x my shares. It just splits the pie into more pieces. It does nothing. It doesn't dilute you. It doesn't get it, your value stays the same, and your ownership in the company stays the same. It just slices the pizza up more. It's just for options and liquidity. Okay. Do you think we will go lower? You know, potentially another. I think the bottom's very close. You know, I don't think we're going much lower. You know, on all the Mag 7, it's very undervalued. So I really just like valuations can't get much cheaper. I really don't think. Like maybe another 5, maybe 8 to 10%, but that like the bottom's very close, and it's worth going ahead and nibbling on some great companies. Like I think Microsoft, Uber is two very fair ones. Thoughts on buying Uber right now or still go deep? You know, don't go crazy, buying the dip yet, but certainly start that nibble. Like if you wanted Uber as 5% of your portfolio like I do, I wouldn't make it 5% of my portfolio today, but I go ahead and make it that little small 1%. So that's why I just bought like $800 worth of Uber on Friday for the first time ever, because they just acquired Spot Hero. They're getting into robo-taxis. They're partnering with Uber, or Uber's partnering with Waymo and Zoox, because it's really the platform. The platform where you go to book a robo-taxi, that's going to be the winner. That's where they collect the high margin fee. And Uber, they don't have to own the Waymo and build all the cars, spend that crazy money buying and building cars. Uber can just collect the high margin fee when they go to book a robo-taxi. So, because they have all the users, they have like 270 million monthly active consumers we were looking at. Should I go over Uber again? That was a fun one. Yo, Sagittarius, I looked at Dave. It's under 200 again. Yo, let's check out Dave. This is one of my favorite fintech stocks. I do own Dave, full disclosure. So, not financial advice on this one. But I own them for a reason, because they're so cheap. Like, I can't believe it. Dave trades at 12 times PE. Look at that, a 12 PE. I feel like they should be much higher. Look at this revenue growth. I don't know why the multiple is so cheap. It's probably just because the industry they're in with like loans, but the revenue's up 62, after grew 40, after grew 22. So they're on an incredible streak of growth, and not just revenue, but profits. They are the most profitable they've ever been. They're literally making like 50 mil plus a quarter now. So they're making 50 mil a quarter, and that's reflected in the 12 forward PE. So they only trade at 12 times net income. And I can't believe it. For a revenue that grows at this pace. And the free cash flow is the best part. That's what FCF stands for. Look at the free cash flow, 91 mil of free cash flow. So actually the earning or the free cash flow yield is like a 12%. So if you buy the stock right now, they make 12% of the market cap just in free cash flow every year. I think net income. Oh wait, it should be actually at a 12 forward PE. I should know that math. It should be like a 12% earnings yield. I'll check. Oh, I spelled it wrong. Okay. Free cash flow yield of 12% and an earnings yield of 8.3. So you buy the stock. That's basically like you could buy a bond that yields you like 5%. You could buy Dave that yields you 8.8% in net income a year, and then you're just trusting Dave to basically invest it to get a higher return. So basically, you don't get the 8.8% net income back in a dividend. You just trust the company, because the company basically gets the 8.8% dividend. They could go invest it into whatever and get a better return on it. So you should get like legit 8% plus your money back a year there. So cheap. Plus the growth there. What's up, Jace? When is booking going to split? Ooh, that's a good question. I don't know if they're going to do a stock split. They love to keep their price really expensive. They buy back a ton of shares. The main way Booking Holdings returns money to the shareholder is buying back their own shares. And look at that forward multiple. It's actually pretty interesting. They only trade at 15.7 times next year's net income. It's like a travel company. I guess if travel's slowing down, but look at these. Yeah, bottom line here, after tax net income, they're easily making well over $1 billion in net income a quarter if you average it out. Free cash flow is well over $1 billion in net income a quarter. Yeah, the analysts expect them to make over $1 billion a quarter. So yeah, 15 times forward PE. Let's see. Merchant segment was $4.25 billion. Gross bookings increased 16%. So nice. Actually, I'm a big fan of this one at a 15 forward PE. I wish the share price was cheaper, but you are able to buy. They are doing a stock split. Sorry, look at that at the top here. On April 6th, they're doing a 25-for-1 stock split. So if you buy one share right now, you'll own 25 more shares in the future. Again, it doesn't dilute you. It does nothing for the stock. It just gives you more shares. Powell Industries is doing the same thing on April 6th, 3-for-1 stock split. Hey, what's up, Plasma? But yeah, Sagittarius, Dave's looking real nice. Let me do Dutch Bros real quick before I go here. Hey, what's up, Matt? We'll do Salesforce after this too before I have to go. I have to go in like 10 minutes, sadly. This has been fun. If you want to hit the follow button, we stream every Sunday at the same time. I sell nothing. I have no course, book, WhatsApp. I'm just going to give my opinion. So here's Dutch Bros. This is like a competitor to Starbucks. I actually like them more than Starbucks. They own a bunch of shops themselves. So the company operated shops are 92% of the revenue. And check out how growthy it is. It's very impressive. It's up 31, after grew 38, after grew 37. So very impressive growth on the company operated shops, and super impressive growth on the franchising revenue. So basically, a franchise opens a store. Every time they make a sale, 5% of every sale goes back to the parent company. The stock is a royalty, a franchise royalty, and that grew 19% year over year as all the franchise pay royalties. And look at the net income projections. It's supposed to be $42 million in 2 quarters. If we zoom out, that's the highest net income ever. Look at that. They really are printing that income now. So I'm actually a really big fan of Dutch Bros. It's certainly more than Starbucks because Starbucks is having a growth issue. One thing hurting them is actually the commodity of coffee and chocolate. The commodity of chocolate and coffee are very elevated right now. That's what Starbucks is saying. So I'm sure they're also probably facing a similar issue. But a lot of restaurants are struggling. But this one's better positioned for better growth, I think, than Starbucks. Consumer discretionary play. A lot of people like to get their daily coffee there. So let's do Salesforce. Heck yeah. VF is historically cheap. Yo, is that we'll look at that one, Plasma. And CTAS. We'll try and get to these before I go here. Problem is there's so many good deals. I don't know which one to pick. Hey, that's a good problem to have, though. It's like, which high quality stock do I want to own for the long run? But yeah, I chose Microsoft and Uber as my two newest ones. AppLovin, I was so grateful to be able to finally buy AppLovin. So here's Salesforce right here. Out of all those software stocks on the dip, this one's a quality, decent one. And they're actually really cheap. Yeah, dang. So wait, where'd the multiple go? Here it is. So Salesforce only trades at 22 times forward PE, but notice the current PE is at 23, so it's only going to a 22, so they're not growing their net income that much. So maybe, so actually look at the past 3 quarters in a row. They're beating like crazy on net income. Oh, I guess it is kind of slight one-time adjustments because they're just barely beating on EBITDA. But anyway, yeah, very diversified. They're in services, sales. Oh, Slack. I love Slack. That's the best acquisition they ever did. They acquired Slack. It's super growthy. It's up 40% year over year. The growth is finally back. Dang, up 38% after grew 12, after grew 11. So Slack was doing really good. Like a ton of the S&P 500 use Slack, even Amazon. So Agentforce integration, marketing, commerce. So interesting. And here's their net income. They make 1.5 to 2 billion net income a quarter. The only bad part hurting the stock is the AI fears. Can companies just in-house create their own like Salesforce, employee customer relations own like spreadsheet software themselves or something like that? But that's really the bet here. I really think it's probably the worst is priced in. I don't know how much lower they can go. They're only at actually, you get a 1% dividend yield here. I do like Microsoft as a safer buy. Like Microsoft is cheaper than this one. Microsoft's at a 20 forward PE. They're saying like Excel and spreadsheet could be replaced by Anthropic or whatever. But anyway, I like the software names. Ooh, what's this one? Wait, VF. What is VF? Oh, VF Corp. They changed. Wait. Let me know. Are you talking about VF Corp? They actually used to own Supreme. Has anyone heard of the like clothing brand Supreme? But they had to sell them off because they were losing so much net income. They had to sell them off actually. But they own some other brands, like they own the North Face. They own like Timberland boots. They own JanSport. So a lot of brands like that. They own Vans as well. Yeah, so they own Vans. So kind of some popular brands. Oh yeah, here they all are here. Timberland, Vans, the North Face, JanSport. I'm actually surprised I remember all that. Not a stock I'd own though. Unfortunately, a lot of apparel stocks are really struggling. Are they back to making good profits? Actually, wow, they really have recovered from what they used to. So look at this. They really made 300 mil in net income. Look at these year-over-year growth rates. It's all really green. This is great news. So, yeah, they really made 300 mil this quarter, 190 mil last quarter, and they narrowed their losses. They only lost 116, 150. So what's the forward PE on this company? I was actually surprised. So actually, they're only at a 17 forward PE. It's actually not too bad. So the only thing is this stock is probably just being hurt because all of the apparel stocks are being hurt right now. So it's not just like a Vans problem. I mean, just look at Nike, probably a very similar stock. Nike stock is the same price that it was back in 2015. Look at like a Lululemon stock. Lululemon also at like this multi-year low or like a new decade low as of Friday. Same price as they were back in 2018. So it's not just a them problem. Lululemon and Nike are also struggling. So CEG is a great choice. I hope they dip to buy more. Yeah, I agree. Outwork. Yes, sir. That's a nice nuclear play. One of the best nuclear plays. Can you look at Ondas? Yeah, hey, this is like an autonomous drone manufacturer. I think they just like acquired a company. So basically this company is converting from basically a company doing no revenue to doing a ton of revenue. So if we go to their revenue right here, like look, the same time last year, they used to do what? Like 4 mil of revenue a quarter. But now, as of this quarter, they did 30 million, and they're not done growing here. Next quarter, they're supposed to do 39 mil, and then the quarter after, 64 million. So literally year over year, revenue is going to go from 6 mil to 64 million. So it's going to be a 10x of the revenue. So it's a really crucial time, game-changing time. So the next 6 months for the company are going to be the most volatile like they've ever been. So they really have to prove themselves. One of the reasons why the revenue is so growthy is because they just acquired a bunch of companies. Like this quarter, they spent $250 million acquiring some like drone manufacturer, stuff like that. So anyway, you're really watching the future growth. Unfortunately, they're still losing a lot of money. Well, not that much money, like 23 mil. But yeah, it's interesting to see. Let's see. I bet they're in the news at least a little bit. Oh yeah, look at this. So another acquisition. Ondesk to acquire Worldview Enterprises for $150 million, and that's just going to add more revenue. Ondesk completes final payment for CS acquisition. So look at that. They're buying more companies. That's probably why the revenue is growing so much, because they're buying businesses anyway. I'd still be careful with that one because it is like they're diluting the life out of the shareholder to do these acquisitions, but I think it's a smart thing for them to do. How's OILY? What is OILY? I've never heard of that one. Evolve Group Canadian Energy Enhanced Yield Fund. I bet they own a bunch of utilities or something, or yeah, oil stocks. Yeah, basically Canadian oil stocks like CNQ, Sun, Core, so Enbridge. Yeah, so these are all Canadian energy names. And basically it just follows the price of oil. So basically it sells covered calls on Canadian oil companies. That's what that ETF does. So it's kind of like a way to maximize your income if you wanted to max income. Um, can you look at Costco and MELI? Yeah, I have to rush through these. I have to go in 6 minutes, so let me go really quick here. Costco is a great staple, great business model, very safe. You have to have a subscription just to get into the Costco store, and whether or not you go to the store every month or every year, whatever, they're collecting that subscription revenue. So anyway, here's their net income. It's very safe and predictable. They're making over $2 billion net income a quarter. People love going to Costco because you get good deals, buying stuff in bulk. They have the loss leaders like the $1.50 hot dog and the $5 rotisserie chicken brings more people in to buy more stuff. They're actually having successful gold sales. They're selling a bunch of gold bars. It's making some good money off that. But anyway, I just like Costco. Unfortunately, they're too expensive to own at a 46 forward PE. I know there's some competition from like Sam's Club. But yeah, Walmart, Costco, those are the two industry leaders for sure. And I don't know if Costco has like an online presence. They can't really deliver the stuff to you in a way that Walmart and Sam's Club could deliver it to your house. That might give Walmart the upper hand, or maybe even Amazon. But yeah, MELI, this is your like South American international Amazon. They do what Amazon does, but I think in like mainly Brazil or yeah, look at that. So this company right here, 52% of all the revenue just comes from Brazil. So it's like a South America Amazon. Then it's Mexico, Argentina. So yeah, unfortunately, they're at like this. They're at the same price as they were back in 2020. So the stock has been flat for 6 years now. But look at the revenue. The stock's been flat for 6 years, but look what the revenue's done over the past 6 years. Here was 6 years ago, 2020. Revenue was 800 mil a quarter. Now it's 8.7 billion just this quarter. So they're having insane revenue growth, great top line revenue. And this is in US dollars as well. And the net income's great. They're making 500 mil, but the profits grew slightly less than so the revenue grew 44, the profits only grew by 8%. So that means the margins did fall, gross margins down 5, the net margin didn't fall this bad. It only fell like 20%, but the margin slightly went down because they are seeing increased competition from Amazon. Amazon just spent a ton of money investing into Brazil, where they actually in the top 6 Brazil cities. I was just reading about this from Amazon. In the top 6 Brazil cities, Amazon is investing a ton of money for same-day delivery of items, of e-commerce items. So anyway, but look at this. MELI announces record 57 billion investment in Brazil for 2026. Yeah, it's their largest market, contributing to 52% of revenue, expanding the e-commerce platform and advancing fintech. So yeah, they have a big fintech app as well. Actually, and the forward multiple is a 30 on MELI. Let me pull up the fintech news. That's the second line here. Fintech segment revenue rose 51%, with total payment volume up 42% and credit portfolio nearly doubling to 12.5 billion. So really good news there. It's a very profitable company, great growth. I'm actually a big fan of that one. 30 forward PE. They might be slightly expensive, but yeah. Hey, thanks so much, Jonathan. I appreciate you. What is TSEM here? Tower Semiconductor? Dang, the stock has done very well. Hey, earlier in the stream, I did do a super deep dive into Broadcom. I think you'll really like it if you can zoom back and find it. Yeah, for everyone watching on the TikTok stream, the number one way to support me is just follow my YouTube channel, subscribe to it, and hit the like button on there. You, TikTok, he's giving me issues like removing my stream from For You page. So I'm just trying to build up my YouTube following, and the stream stays up there forever. So if I'm talking too fast or if you miss anything, you can rewind it on the YouTube stream. That's the best way to support me. But yeah, here's Tower Semiconductor. The stock's done phenomenal. They're doing analog foundry operations. So they're making analog chips, kind of like Texas Instruments. So yeah, they really do print good money. 80 million net income. Is that a record? Yeah. Excluding that one-time adjustment, or the growth is finally back is what it looks like. So they had great net income, 70 mil this quarter. Fortress balance sheet, literally no debt on Tower Semiconductor. So 1.15 billion of cash and no debt. Wait, 1.15 billion of cash and the company's worth 19 billion. So 5% of the market cap is just cash. Interesting. They pay a dividend as well. So yeah, they're a semiconductor play. They're in they're in the ARC portfolio. So they're part of Kathy Wood's, I guess, ETF. So where analog meets value. So I guess they're the manufacturer. So they make analog chips. Interesting. Wait, where were they headquartered? Headquartered in Israel. Okay, so just beware, but just know they're headquartered in Israel. So this isn't a US company. Where does the revenue come from? Okay, US is 42% of the revenue. They're headquartered in India. Pretty cool. So, hey, thanks so much, Native. Actually, I think the very last one we can look at is Broadcom. Yeah, let's do Broadcom. What is PE? The PE ratio is the price to net income. So when we look at Broadcom right here on the left, they're at a 58 PE. But look at the forward PE. For growth companies, you look at the forward multiple. The forward PE is they only trade at 28 times next year's net income. PE stands for price to EPS, and EPS is just net income per share plus any share dilution or buybacks. So basically, the PE ratio is a price to net income plus any share buybacks or dilution. So best thing, which is really the best metric to look at because it includes those non-cash expenses such as stock-based comp that free cash flow doesn't, where constantly companies are doing these accounting tricks, but that's why you look at a forward multiple at 28 forward PE. This is super impressive. It's literally their net income's going to double. It's going from a 58 to a 28. So you only trade at 28 times next year's net income. Look at these net income projections. This is what is insane. The net income in 2 quarters is supposed to be 11.95 billion. So they're going to make 12 billion in net income in 2 quarters. If we zoom out right now, it's never even been near 12 billion before. It was 7.35 bill, 8.5 bill. So they're going to make just an incredible record net income. That's why I think this one's justified because they're still having future growth. The growth is not gone. They're just falling because the whole market's falling, like Nvidia is falling, but they still have crazy growth because of their TPUs. Google is like their number one customer with their TPUs right now. I don't know if we can find any news on that, but yeah, their semiconductor solutions, check this out. Just this quarter, at the very top, the year-over-year growth rate is a 52. So it grew 52% year over year, after grew 16, after grew 3. So literally the growth rate is growing and it's not stopping. They have a huge backlog and they're big in VMware. If we look at the annual software revenue, look at that. Full year 2023, it was 7.6 bill. Now it's 27 bill for the full year 2025. It's insane growth. So that's why I really like Broadcom as just a growth company. You get a good yield as well, a close to 1% dividend that they raise every year. Then they can raise the dividend and do buybacks too, because as we can see, the net income is supposed to be 12 bill. The basically EBITDA, look, earnings before interest taxes is going to go from 10 bill to 19. So a lot of future growth on Broadcom, and that's why I find that one pretty fascinating. Forward PE is the same now as it was in the April tariff low. Yeah, isn't that crazy? LGN, all right, we can do Legions. Oh, this one's on my watch list. This is a HVAC play. HVAC company, I believe. Yeah, maintenance and installation. It's kind of like this reoccurring revenue business. And basically right now with the construction of data centers, what's super in demand are MEP workers, which are mechanical, electrical, and plumbing workers, MEP. And this is a big MEP place. So let's see. I believe the engineering and consulting segment designs HVAC and other MEP systems for buildings. And so they basically help do the complex mechanical and electrical work. And I'm sure data centers are really booming. Yeah, they beat on revenue. They just IPO'd. They haven't even been public for like 8 months. So they just IPO'd. But yeah, revenue growth is great. They kind of remind me of like a Comfort Systems. They're on my watch list. They remind me of a Comfort Systems. But anyway, I got to go. I hope you have a phenomenal rest of your Sunday. I'll see you in the next one. Make sure to hit the follow button. The best way to support me is subscribe to my YouTube channel. I'm trying to build up my YouTube channel. It's called Nathan Robert. It's in the link tree in my bio, but you can just type into YouTube Nathan Robert. And if you're looking for a brokerage, if you want to buy stocks or are interested in stocks, my favorite app to buy stocks on is this one I'm on right here. It's the app I use the whole video to analyze stocks and stuff. If you want to get it, it's the very first link in the link tree in my bio, or it's the very first link in the description if you want to use my affiliate link to get this brokerage I'm on. If you go and like deposit $100, I'll both get like some free stocks. But yeah, see you soon. Hope you have a great rest of your day. Thanks again. See you tomorrow. Hey, see you, Sagittarius, Native, Stone, Plasma, Emilo, Marcus. Thank you to everyone who was on this YouTube stream. Y'all are the best. I appreciate it.